Autos at the top of the list yesterday, along with healthcare. We'll see if that's a trend that continues today. We're also watching the impact on the miners as well on softer iron ore prices, but it's really all about Anglo when it comes to that sector, of course. We are just 8 seconds away from the open, with European futures pointing to very modest gains. US futures currently flat. Let's check in on the markets then, and we'll start with the sector look as well, Guy and Anna.
Absolutely. Let's get an idea of what some of the single stocks are doing. Yesterday, I got caught out because Novo Nordisk was coming off a holiday, 2-day holiday in Denmark, so it had risen. But actually, in terms of the points, it continues to add today. I think it's going to the market with some debt as well. It's interesting that some of the French banks are actually... SocGen is up by 2.23%. Did Emmanuel Macron just paint a little target on SocGen's back, I wonder, in his interview with John Micklethwaite?
He was asked whether he would be comfortable with Santander, as an example, as a hypothetical, making a bid for SocGen in part of that conversation about banking union. So we're seeing a move there. Whether or not ties that to those comments can be interesting. 2.5% gain currently for SocGen. Just some of the delivery companies as well in focus. Delivery Hero selling part of its business in Asia, Taiwan, to Uber as well. So we watch those stocks. And then we got Bayer. Bayer coming in with some better than expected earnings. They face all this litigation risk, of course, but that stock in focus for us today. Bayer coming in with slightly better earnings print, Anna.
Yeah, in terms of the sector breakdown, we were pretty evenly split yesterday, and today not all that different. I was just looking at the worst performing sector is travel and leisure, but it's the leisure side, if you like, it's the gaming side. Flosser Entertainment seems to be weighing down on that sector rather than aviation, which is actually doing okay this morning.
IAG hit a 52-week high yesterday, which is interesting, that it is kind of pulling away from the rest of the pack here in Europe. That's the North Atlantic story,
US
and it continues to drive it higher. But utilities are up again. So this is the kind of the bond proxy trade, which a lot of people are talking about in terms of how you play Europe. You're looking at bond market outperformance relative to equities, maybe seems to be some of the narrative that's emerging. And if you want to therefore play that narrative through the equities channel, do you play it through the utilities, which kind of fit more naturally into that kind of a trade?
Yeah, I mean, that was a sector that was being, well, so that's utility space. You mentioned the banking sector earlier on as well, and that's in focus after that Emmanuel Macron interview that John Micklethwaite did. I was also looking at the energy names, given that he might have sounded relaxed and even encouraging about cross-border banking M&A, but not so relaxed about the idea that Total Energies might go looking for a higher value over in the US. But that sector is a sector that is gaining this morning, up by around 0.25%. Total Energies just up by 0.2% in that context.
Anglo barely moving on the back of this pretty seismic news that's come through in terms of the potential restructure there. Just up 0.2% so far in the session. BHP, of course, that continues to court this company, down 0.3%. So far, it seems investors kind of still adjusting to this news about a potential, obviously, major restructuring at Anglo, and they try to derive more value and push back against this takeover bid from BHP.
So go ahead.
No.
I was just thinking, looking at the points breakdown and what's moving on the points basis, and it's your old friend Guy, Novo Nordisk, to the upside. Only 0.7% higher, but obviously it's such a heavy weight that it provides the biggest points gain on the Stock 600 this morning.
So there's an investor call, there's a conference call that's just started. I think it's actually a media call, if I'm being more exact. CEO Duncan Wanblad, this is the CEO of Anglo, is on that call. We'll be taking questions. We'll be answering some of our questions that we've got this morning surrounding what is happening here. Let's dig further into what we're anticipating with our executive editor for Energy and Commodities, Will Kennedy, who's actually in Melbourne today. So the time zone still working in our favour. Will, your thoughts on what happens here next? In some ways, this clears the way for a takeover. because in some ways everybody's now on the same page in terms of what needs to be done with this business. How does the announcement this morning, which is clearly defensive in nature, change the narrative? They're basically saying at Anglo, we're going to do what they're going to do, but we want to keep the assets, the copper assets, in our own hands. How does that change the story from a BHP point of view?
Morning, Guy, or afternoon from Melbourne. Look, it's a very dramatic response by Anglo, as you've all been saying, and clearly it goes a lot further than some people had been expecting. But how does it change things? Well, look, if you're an Anglo shareholder, you clearly get more value out of this. You clearly are getting a lot of the things that people want, which is to concentrate on the copper, to make the group more streamlined, easier to understand, to get rid of some of the problematic businesses like platinum, but you get it without all the execution risk of a very big M&A deal. And those risks are antitrust, and we all expect that there may be issues in South America. The Chinese might want to get involved. South Africa may be more comfortable with Anglo doing this in South Africa than they would be a BHP forcing their hand. So there are attractions, presumably, for investors in having Anglo's existing management do this. It's a real statement of intent, and the ball is back now with BHP, who are going to have to think whether they want to come back a third time with a higher offer, which just is too compelling for shareholders. And that's what we will be watching over the 8 days or so until this deadline that BHP has on May the 22nd.
Okay, so we have 8 days to watch for what happens next then in terms of a BHP response, Will. In the very short term, very little is happening to the share price. Anglo American, well, it was up by not even 1/10%. Now it's down by not even 1/10%. It's really not going anywhere in a hurry. What would you expect? Does that send us any kind of message, Will, or are we just all still waiting to see what BHP wants to do?
Look, I mean, I think, you know, clearly we're a little way off the offer price, I think, definitely not a long way beyond it, which suggests that investors remain skeptical, A, whether BHP will come back, and B, whether they can get this deal done. This has always been a very complicated deal to get done for all the reasons we've been discussing over the last few weeks, principally the situation in South Africa. And I think that skepticism remains among many investors, and that's what the share price is telling you. Equally, that probably shows that investors are not willing to give Anglo full credit for this plan as yet, that they want to hear more about it. They want to believe that Anglo can get this done and get it done quickly. So I think investors are a little wary about most management teams right now, judging by the share price.
Well, just if we step back and look at the broader implications for the sector on the back of how this story transpires, how do you see if this deal goes through? Does it spur further acquisitions within the space, or does those acquisitions happen anyway, independent of the fortunes of Anglo and BHP?
Look, I think one thing that you can take from Anglo's reaction to what's happened, to their announcement today, which is more dramatic than some of us may have predicted, is that no matter how this pans out in the end, that the mining industry will change because of BHP's approach of Anglo, that the mining industry in a year, in 2 years, is not going to look like it looks like today, that you're going to have a radically reformed Anglo-American. And I also think that, you know, deals are back in the air in this industry. Clearly, people are thinking about how to change their mining portfolios to become more ready for the future. And I think for a lot of companies, that means, principally, as we've been discussing, more copper and less reliance on iron ore and coal. And you're seeing that process play out. Exactly where the pieces fall remains to be cleared, but remains to be seen. But Rio Tinto, the one big company that we haven't talked much about yet, will have to look at its strategy and think about where it can add copper. And if investors decide to stick with Anglo's management team and their ideas, then BHP will have to think out where it's going to get more copper. So yes, I think we're at the start of a very interesting time in the mining industry, and the next 2 years will be full of stories.
Well, thank you very much indeed for joining us from Melbourne. Our executive editor for commodities, Will Kennedy. Amplats is down pretty sharply in South African trading. That's probably worth noting as well. There is a call that is underway currently with the Anglo management team. They'll be answering questions. So we're going to get more headlines and more detail on this plan that has been put out this morning. The other thing I want to flag is that the QEF, the Qatar Economic Forum, is now underway. The Qatari Prime Minister is now delivering opening remarks. If you want to follow this, you can do so, of course, on your Bloomberg terminal. We will be back there shortly as this event kicks off. But let's get back to the single stock story that we're watching here so carefully this morning. This is what the sensational six look like this morning, the core six, as we probably should call them here in Europe. Stocks that you want to be watching out for to give you an idea of what is happening, just to kind of flag the story. It's interesting that luxury stocks, Ferrari down this morning, LVMH a little softer this morning, and Nestle down. But Novo Nordisk continues to power higher, which is fascinating. It's had a very strong session yesterday. It's building on that today. What else are we watching? Let's go to the delivery business and see what's happening. Joe Easton, what do you got?
So we are starting with deals then, and it is delivery. As you say, we were looking at mining in terms of Anglo, but the big mover is delivery here, up 19% in Germany on news that they're going to be selling their Taiwan business to Uber. Uber moving further into Asia with their Uber Eats business. They have been trying to offload that unit for a number of years, and they are finally doing it today. Though I was reading, there is actually some concern around regulatory issues. Will that get approved? That was the take from Bloomberg Intelligence just breaking, but the market is loving that. We're up 19% at the moment for delivery hero. Then Tratton coming down. Bloomberg deals team saying that there might be a big share sale. €1 billion could be offloaded by Volkswagen. That's weighing on that one significantly today, down almost 2%. Anglo, you were discussing there with Will Kennedy, we're ticking up around 0.4%. We'll have to wait. Where does this go from here? Diamonds are not forever, as you've been saying with that potential asset sale. Then SocGen potentially reacting to these comments from Emmanuel Macron to the Bloomberg editor-in-chief. The trader I was talking to today said that SocGen would be the most likely sale target. Probably BNP would be a bit too big, as would Credit Ag as well. So that one seems to be getting a bit of boost on that interview there. Then in terms of some other earnings we've got today, there's Vodafone ticking higher. We have seen a rebound in Germany. The UK still looking weak. We didn't see another buyback. We got Flutter Entertainment down 2.5%. I'm told this is due to strong basketball results, meaning the punters are winning and Flutter is losing over in the US. I know absolutely nothing about that sport, but that doesn't sound good for them. So that is coming down almost 3% now. And then Greggs, we love looking at Greggs because it gives us an insight into what people are eating. It's chicken goujons, it's sliced pizza, all of those delicious lunch snacks. But why isn't it doing well? Well, that stock already trades at 20 times earnings, so that one is actually coming down, giving up some gains. We've also got Sonova. This is in the ear and eye care business as well, and that one gaining 6%. Most of that is in hearing aids. That one's over in Switzerland and it's up 6% today. We'll quickly look at some German earnings as well. We've got a bunch of them out. It is a busy day for them. Rheinmetall, look at that one, down 6%. This is the defence supplier, the biggest German defence supplier. A massive rally for that one, so giving up gains following earnings. And Nordics in wind energy, rebounding following some of those losses spurred by Donald Trump's comments yesterday. And a couple of others. TAG, this is in the real estate business, just ticking to unchanged at the moment. And Brenntag in chemicals. A couple of weak ones over in Germany today, perhaps indicating something about the economy over there. And speaking of that, we'll quickly look at those UK stocks as well, because we did get that economic data. Wages starting to come down, but still looking pretty strong. But we've already had the Bank of England last week, so at the moment we're not seeing a huge reaction in the banks, in the home builders. Pretty steady across those. Then a couple of morning calls to bring you EQT. This is an interesting one because JP Morgan reckons you should be buying one of the largest private equity listed companies. They go overweight on that one, potentially a rebound in M&A. That is what JP Morgan is saying. That should be good for EQT. And finally, DHL going the other way in Germany is Exane downgrades. This one, they are warning of a potential easing in some of the shipping demand for DHL, and that is a key indicator of the global economy. That one goes to neutral. 43 price targets, trading at 39, and that one's slipping on the DAX index.
Joe, Thank you very much indeed, Joe Easton, on some of the single stocks that we are covering for you this morning. I want to take you back to Doha. The Qatar Economic Forum is underway. Francine Lacroix in conversation with the Qatari Prime Minister. Let's take a listen. Fran introducing this panel. Let's go straight there. This is Bloomberg.
Well, it's been actually a very long process, and especially in the past few weeks, we have seen some momentum building, but unfortunately, things didn't move in the right direction. And right now, we are in a status of almost a stalemate. Of course, what happened with Rafah has set us backward a little bit. I think, you know, there are a lot who are not understanding the nature of this conflict and mediation, and there is a lot of misconception about it. Because if we will look at it, when there are two parties who want to agree on something, you need to agree on the baseline, first of all. And I believe that what we are seeing, there is a fundamental difference between the two parties. There is one party who wants to end the war and then talk about the hostages. There is another party who wants the hostages and wants to continue the war. And as long as there is no any commonality between those two things, it won't get us to a result. I believe it's very important for all of us right now to see what's happening with all this destruction that's happened in Gaza. Enough is enough. We need to stop the war. We need to focus on the future. What's the catastrophe in Gaza, actually, if you look at it, most of the reports saying that it will need 40 to 50 billion to rebuild it until 2040. So the amount of destruction, we didn't see much of it. Only what we see on screens probably will not represent more than 10-20% of what's really there happening. And of course, you know, adding to this the risks of the spillover of the war, and we have seen, you know, the region became a very turbulent region, whether it's on the Red Sea, in Lebanon, and this risk is just going to increase as long as the war is ongoing.
But Prime Minister, more immediately, do you see any silver lining? And how does the current fighting completely stop?
Well, we believe that the best way for us, that's what we'll be calling for, that to reach an agreement where we recognize that the ceasefire is required now. We need to stop the killing. We need to stop this atrocities that's happening. And of course, to negotiate a deal for the hostages. I think that if those two elements aligned, we believe we can have a deal, you know, in just in a matter of days. But as I mentioned to you, probably there is no clarity how to stop the war from the Israeli side. I don't think that they are considering this as an option. And there is also, you know, unfortunately, like a stereotype, even when we are talking about a deal and potential leading to a potential ceasefire, a lot of politicians are, you know, retracting us by their statements that they will remain there, they will continue the war, and there is no clarity on what Gaza will look like after this.
So there's not much hope there.
Well, I'm always hopeful, so I cannot say that there is no much hope. Of course, we will keep trying, we will keep pushing, but it's at the hands of the parties at the end of the day. Once they are willing, they will find us helping and facilitating and bridging the gaps.
Yeah, but do you see Qatar as continuing having a role in these negotiations?
Well, we didn't stop. We had actually some challenges in the past few weeks. We did a reassessment of the attitude as well. I mean, also we didn't want to be used or abused as a mediator. And to make it very clear for everyone, our job is limited to our mediation role. That's what we will do. That's what we will continue to do. Of course, whenever we are needed, we are stepping up. We were needed in the last 2 weeks in helping in the negotiations, and I believe we made a very good progress in the last round.
Prime Minister, there has also been talk about Qatar asking Hamas leaders that reside in Doha to leave. What's your country's stance on this?
Well, there is actually, there are a lot of speculations about this. And basically, if we look at this specific issue, we need just, to understand the backgrounds. When Hamas started their presence here in Doha back in 2012, it was for a reason. It was to serve as a political office for them to create a communication channel between them, the Israelis, the Americans, everyone. And this channel proven to be effective. I mean, if you look at different conflicts from 2014 all the way until now, this office played a key role in it, including the hostage release that unfortunately a lot of politicians have forgotten. Around 109 hostages been released because of the mediation that's been facilitated and mediated by Qatar. And it was the only hostage release that happened throughout the war, not by the military action or not by pressuring or doing so. And we believe that as long as the war is ongoing and there is a need for the communication, there is nothing to be entertained in that area. Our view here in Qatar that we need to be, accessed for different parties to resolve conflicts. We are not parties of the conflict. Like our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
But Prime Minister, and you allude to this, there was wide regional consensus, right, behind the events that led actually to Hamas relocating to Doha, including the US. Do you see those dynamics changing?
We don't see any change. Right now, everyone is focused on the current mediation. Everyone is focused on how to get to a result to end the war and to get the hostages back.
So on the rebuilding, under what circumstances would Qatar contribute to the rebuilding of
this is actually, it's still a premature question because no one is talking about the day after from our perspective in a realistic manner. There are multiple views you are hearing here and there. We believe in one Palestinian government that should be in charge of West Bank and Gaza. And this Palestinian government should be built on consensus between the Palestinians and to lead the transition of the country. Whether this will be, allowed by the Israelis, and we have seen the statements by the Israeli government that they don't want the PA even to be there. And I think that if we will end the war in a state where the country is destroyed, no vision for it, no vision for the PA to go in, it will be very difficult not only for Qatar, but for the rest of the world to step in and to invest in unknown. That will remain a challenge. So we always encourage, and we are working together with our Arab partner, what we call it, the Committee of 6 Arabs, and the US, in order to try to think about what's the best way to transition to the day after in a way that will not actually affect the Palestinian people, will not affect the Palestinian cause, and will not undermine the Palestinian Authority.
Prime Minister, can you touch on some of the investment plans actually for Qatar? Are there any regions or actually sectors that you find particularly exciting right now?
Well, we are very much, actually, our focus in terms of the sovereign wealth fund and the investment that we are investing internationally, it continues following the strategy of diversification, which is mainly we invest in everywhere in the world where there will be a high return. We ensure that the balance is struck within the portfolio. Of course, US has been, in the last few years, one of our main markets. Asia is an interesting market for us, and we have invested over there, but also we are exploring new opportunities, but also trying to expand to new emerging markets like Central Asian region and Africa as well. Our focus is, as you know, sovereign wealth fund, it's for future generations. So we wanted to make sure that these investments are not high in risk, ensuring the stability of the jurisdiction where we are investing, and ensuring the sustainable income. On a local front, we just launched our National Development Strategy 3, which is, we see it as like the last mile toward achieving Vision 2030. And if you will think about it from perspective where Qatar, in the last 25 years, focusing on building energy infrastructure, then the hard infrastructure preparation for the World Cup, now is the moment to capitalize on all what's been built. And what's really at the center of this strategy, focusing on human capital and all the investment that we have done in education and the human capital that Qatar have right now, unleashing their potential, opening up opportunities for the private sector, government to step back from a lot of things and to just remain as a regulator, creating, there is a significant incentive schemes that will be created to encourage private sector and foreign direct investment, focusing on areas of manufacturing, logistics, RRC, and tourism, ICT, financial services. Of course, there are a couple of sectors which are prerequisite, which is the healthcare and the education, and we have already made very good progress in investing in the infrastructure. Of course, the healthcare has more potential to improve the economic side of the healthcare, which is basically research and development, and hopefully pharmaceutical industry in the future.
But we talk a lot about AI and semiconductors.
Yeah.
Is there anything of interest in that industry?
Well, actually, right now we went through a review for the last year. Where can we position ourselves? And we believe that AI world is a big world, and it will need a lot of investment to come in, whether it's on the infrastructure or on the application side. Now, our focus here in Qatar is how to become more complementing for other countries in the region as well, because there are ambitious plans also taking place in UAE, for example, in Saudi Arabia. And we are focused in some verticals where we have already created the national champions, and how to enhance those national champions and take them to the next level by using artificial intelligence. And of course, on the infrastructure side, there is already some infrastructure being built, and now we are moving on to expand it and to grant part of it for the research element. Of course, the education institutions are very important, so that's why there are AI programs started in different universities here in Qatar. And last but not least, that what I've just mentioned in the speech, the Arabic large language model, which is for the first time, this is something that we are just launching. It's called Fanar, where we will have a system that will be fed by the Arabic language and also the values and the Arabic culture, because we see there is a huge potential in the Arab market where application developer and others can come in and can use it for their development.
Prime Minister, you mentioned Saudi Arabia. Have the Saudis, do they want Qatari investment for their Vision 2030? Have you provided any, or will you?
Well, we've been doing a lot of things collaboratively, actually. We have invested in a few opportunities over there in Saudi, and of course the Saudi market is a big market, very important market for our businesses as well here, and we've seen there is an increased interest in Qatari companies to go there also and to do some businesses over there. And look, I think that, you know, when we look at ourselves here, we look at ourselves, Qatar, Saudi, UAE, others. But when the world is looking at us, they look at the GCC as one unit. And you will see someone who's coming and visiting Qatar, the next day he will be in Abu Dhabi, the third day he will be in Kuwait or in Riyadh. And the same thing, it's happening. So whatever any country will do, the other countries will have an indirect benefit to it. And I think that there is a huge potential. And right now we are very much connected in the connectivity between the countries. So this will also ease the trade and the business together.
Prime Minister, do you worry that economic uncertainty makes it more difficult to attract capital to the region and to Qatar? You know, the various US, China, for example, difficulties.
Well, it's a challenge, but I believe for us in the region, it's an opportunity. I think that when, you know, there are a lot of, we see a lot of interest coming from the US, a lot of interest even coming from China. And I mean, as we are brokering peace, we hope brokering peace in the economy here.
The one thing that everyone's looking to is, of course, the US election. What kind of policies would you prefer? Is it easier to deal with a Republican president or a Democratic president?
Well, honestly, it doesn't make any difference. We have built a very long relationship with the institution over there, and despite the presidency, this is the US system. So we should expect one time a Republican and the other time a Democrat, and it's fine. I mean, the institutional relationship is the key, and it's the cornerstone for the relationship between our two countries.
In terms of the policies, do you expect, I mean, they're very different.
There are differences, but relates to the Middle East, we don't see much difference, honestly. And we have seen that we worked with President Trump during his administration, and there were, like, you know, approach for some regional issues where we have our point of view. We discuss it with them. They listen, they change sometimes not. And we respect. And the other, with President Biden as well, we are working with them very closely. And I'm sure you have seen what's happened. In Afghanistan deal happened during Trump administration. Then President Biden, we did with him the evacuation and all the transition after this. We are doing together right now the ceasefire in Gaza, but also other areas. And I think we are working very well with everyone.
Prime Minister, we talked a lot about volatility and some of the challenges and some of the opportunities. What gives you the most hope for the next 12 months?
Well, actually, first of all, you know, it's when you look at the pyramids of needs, you need security. And as long as this war is ongoing, regional security will be threatened. And we will have, you know, it will be very much unpredictable. So that's why even Qatar now, currently the president of GCC, what the theme of this year, we were very much focused on getting all the GCC partners to think about what is the best regional security framework that we can work together with in order to ensure the security and the stability of our region. What's really worrying me is, you know, the escalation of the war, the continuation, plus the uncertainty of some of the politicians just to continue the war without having any direction where to go or what to do. And that will just put us at risk of, you know, spilling over. But also, Post the war, actually, even if the war stopped and there is no rescue plan for Gaza, I think the problem will be bigger. And in the medium term, we are very much worried after all these images to see like another wave of radicalization. So security is the key for us in the region. We need to preserve it as much as possible.
Prime Minister, thank you so much for your time today. Thank you.
Francine Lacroix, of course, speaking with the Qatari Prime Minister, talking about the situation in Gaza, of course, at the start of that conversation, moving on to the investment opportunities in the region, and then back to Gaza at the close. War as a threat to regional security, and even after the war, even after it comes to an end, fears about regional security and trying to preserve that at all costs. We'll be back to the Qatar Economic Forum momentarily. A quick pause to check on what's happening in the European space on these markets. Perhaps we're pretty flat, not moving very far. We have been hearing from the CEO of Anglo American, whilst Francine was talking to the Qatari Prime Minister, saying that there's, and one of the things he's been saying is that any buyer of the new Anglo would have to pay an enormous price. So that's the M&A story that we're watching this morning. We've seen Anglo American fight back and come out with an announcement about all the assets that they're selling this morning. That's one of the big stories we're watching. We're just waiting to go back to the Qatar Economic Forum momentarily, but guys, European equity markets waiting then for CPI.
Absolutely. We're waiting for that CPI data. We're going to get PPI data today. We get NFIB data today. We're going to hear from Powell in Amsterdam today. There's an awful lot happening in this afternoon's session. It feels like maybe markets just sitting on their hands a little bit, digesting the Anglo news, listening to the call, and maybe trying to get some takeaways exactly in terms of how that is going to progress. As Anna says, we need to return you though to the Qatar Economic Forum. Bloomberg's editor-in-chief John Micklethwaite is in conversation with Poland's president. Let's take a listen.
We have got a long historical experience with Russia.
Wielokrotnie byliśmy przez Rosję okupowani.
We have been
My
occupied by
jako
Russia
Polska
on many occasions. We as Poland.
Przeżyliśmy bardzo trudne chwile w
We
naszych
lived through
dziejach.
very difficult moments in our history. We
Wielu członków
have
naszych
lost
rodzin
many members of our families who are murdered by Russians under different circumstances. And today we know one thing, that Russian imperialism is reborn, and it is not really important what name this imperialism has at a given moment in history. If we're speaking about Tsar imperialism, Soviet imperialism, or Putin's imperialism, which is now, this is actually the same Russian imperialism, which has got the same features. It is greedy. It is a kind of colonial imperialism, to be frank. The thing is that they're not looking for countries far away to subjugate them, to conquer them, but they're subjugating countries in the neighborhood of Russia. By doing so, they're spreading their influence, and by doing so, they're building their sphere of exploitation of other states and nations. Today, they want to do it with Ukraine, but we know very well that if they managed to win in Ukraine, if they manage to accomplish their goals, they will keep on attacking. They will attack other countries. Perhaps these could be the Baltic states, perhaps this could be Finland, perhaps this could be Poland, or perhaps these could be other countries which used to be part of the Russian sphere of influence. Perhaps they will try to attack in the southern direction or in the eastern direction, but if they win, if the free world allows Putin, allows Russia to win this war, then we will have to do with another Russian aggression.
A very powerful statement. I know that throughout this war, you have always been a passionate supporter of Ukraine, and Poland has also given a lot of equipment, more than most other countries. But Romania has now just said it would send Patriot systems to Ukraine, and I wonder, is Poland ready to follow suit and send Patriot systems as well?
Yes, it is true. Right from the beginning of the war, we have been helping Ukraine in a very significant way. And I want to say it in a very firm way. It tends to be forgotten sometimes. We were the very first country which sent a lot of armaments to Ukraine. We were the ones who sent our main battle tanks. In total, we have donated to the Ukrainians more than 300 main battle tanks from the stocks of our armed forces. We have donated to Ukraine the equipment of the value of $4 billion from that stocks of our armed forces, and we keep supporting Ukraine militarily all the time. But please bear in mind that we are the ones who are potentially in this zone of risk, of threat, and that is why we are modernizing our armed forces to a huge extent. Right now, we are spending more than 4% of our GDP on defense in Poland. This is totally accepted and approved of by the Polish people. We need to stress that. We are a democratic state. We have got elections where the authorities are elected, and of course, the issue of spending, this is the burden on the taxpayers, and this is always a very important issue. But right now, nobody is disputing that in Poland. Everybody understands that we have to spend a lot of money to modernize our armed forces, and this is what we are doing right now. Indeed, we are buying modern defense systems in the United States, also in South Korea. And in this way, we are also adding new equipment to our stocks. We need to modernize as soon as possible. First of all, what we have to do is to replenish our stocks, also filling up for what we donated to Ukraine, because we have donated that equipment from our soldiers, from the stocks of our soldiers. Today, we are purchasing new equipment for them precisely so that they have means and way to defend Poland if aggression happened. But let me stress once again, we keep supporting Ukraine all the time. And first and foremost, we keep lobbying all over the world, across all our allies. We are lobbying to support Ukraine because we believe that this is of key importance right now in terms of survival for Ukraine when it comes to not allowing Russia to win the war.
The Patriot systems, yes or no? That was the question.
Right now, we are only getting the first elements of missile defense system, Patriot, which we have ordered in the United States. We made that order, we ordered that equipment 7 years ago. Right now, the first elements of this system are coming to Poland. So it's difficult to say right now that we could be providing Patriot systems to Ukraine because, as a matter of fact, we still do not have this system in Poland. We do not have it fully complete to provide for our own defense because right now we are only in the process of building our defense system. It's going to be a 3-layered system, starting from the Patriot system through a medium-range system to low-range system.
You put forward a very passionate argument for how dangerous Russian imperialism is, and you also expressed all the different reasons why we need to stop Putin in this. But going back to that question at the beginning, at the moment, that shows no sign of Russia retreating. It seems to be taking more territory. Do you worry that America has acted too late?
I am very calm, and I need to stress very firmly, America right now is giving the biggest support to Ukraine. And this American support to defend Ukraine is of absolutely key importance. Without that support, probably Ukraine would not be able to defend itself from Russian aggression at all. And Ukraine is defending itself. So let me stress, we were the first ones, indeed, who donated tanks, and we offered Ukraine to also supply fighter jets, MiG-29s, which Ukrainian pilots were able to operate right away. This is what we did. We donated MiG-29 jets to Ukraine. But indeed, the help from the United States, from the biggest military power in the world, is the biggest to Ukraine and the most significant. Let me stress very strongly. I am grateful to the United States of America, to U.S. authorities. I am grateful to the U.S. Congress, both to the Senate and to the House for taking the decision. I'm also grateful to President Joe Biden for taking the decision to give to Ukraine huge funds for defense. The decision was recently taken, and in the last 2 months, I also had conversations in the United States about that. I talked, among others, to Speaker of the House, Mike Johnson. I talked to him in March. That was when I was invited by President Joe Biden. I also visited the Congress, where I met with representatives of the Senate. I also met representatives of the House of Representatives, precisely with Speaker Mike Johnson. We talked about that, and I'm very much satisfied, and I'm very grateful to the U.S. authorities that they made decision to support Ukraine, because Russian offensive is approaching. The fact that it will happen is absolutely certain, actually. It is all about climate in our region, in our part of the world. Probably within the next few weeks, we can expect that offensive to happen when only the ground is dry and when it stops being that muddy, because spring actually makes it impossible for heavy equipment to move on the ground in Ukraine. So when only it gets drier, probably Russian offensive will start. And I believe that the Ukrainian armed forces, that the defenders of Ukraine will have received that support by then. This support is coming right now in Ukraine, to Ukraine, and we are seeing that in Poland, because we are the state which is the transit route to Ukraine, and actually all the assistance to Ukraine goes through Poland. And also this is the way we are supporting the defenders of Ukraine, by making available our infrastructure, our roads and our airports, our seaports. We're making them available for the support to Ukraine to be transported, and this is happening. This support is going right now.
That sounds to me like better late than never. But when you also talked about meeting American officials, Donald Trump, you also saw, and the interesting question is, what will he do about Ukraine? There is a theory out there, held by many people, that Vladimir Putin is hanging on until Donald Trump comes in. Again, to quote Viktor Orban, who sat here last year, he said that Trump won't
Chief
give
John
a penny.
Micklethwaite in conversation with Andrzej Duda, the president of Poland, and you can continue watching that conversation on Live Go on your Bloomberg. We will be back with more in the next couple of minutes. Stay with us. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AfDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
48 minutes past the hour. Welcome back. You are watching Markets Today. I want to draw your attention once again to the conversation that our editor-in-chief, John Micklethwait, is having with the Polish President Duda right now at the Qatar Economic Forum. If you'd like to continue to watch that conversation, listen to that conversation, you can, of course, do so on your Bloomberg terminal. All of these fantastic conversations that are coming out of the event are on Live Go. So if you want to follow on, very easy to do so. However, let us turn our attention now to what is happening a little bit later on in the United States and tomorrow in the United States as well. We're going to see a series of inflation prints coming through. We've also got the NFIB data going to be coming towards us as well. Plus, we are going to see Jerome Powell speaking in Amsterdam a little bit later on. Giulio Renzi-Ricci, Vanguard's head of asset allocation for Europe, joins us now to discuss all of this and the setup. As I think about Europe, the ECB, the Bank of England, and what they are going to do next, how important is what we're about to see out of the United States in determining how many times the Bank of England can cut this year, how many times the ECB can go as well?
I think it's going to be crucial indeed. I mean, there is now policy diversion in terms of monetary policy, right? Like, for instance, the ECB was behind the cycle in monetary policy. Now they definitely look ahead, or at least from our perspective. What I mean by that is that we do not foresee the Fed cutting this year over the course of 2024. So we think it's going to stay, the Fed will stay within the 5.25, 5.5 range. And that, of course, creates some challenges, I think, also for the Bank of England and the ECB in cutting more than what maybe the numbers would allow them to do. So our base case right now is for the ECB to have 3 cuts starting in June over the course of 2024. 1 month ago, if you did ask me the same question, I would have said maybe 4 cuts was in the plan. Now, because of policy divergence, I think they're going to be a little bit more conservative.
How much of it's down to policy divergence and how much is down to the data that are actually starting to improve in Europe as well?
Absolutely. I think it's both. The data indeed help the ECB in making those cuts in terms also in economic resiliency. So we're forecasting overall decent growth in real terms for the euro area by the end of the year, around 0.8, so slightly above the consensus. And of course, they don't have the sticky inflation in services and shelter, which is like the big elephant in the room, in my opinion, in the US. So the data, of course, act in favor of ECB to cut and Bank of England as well. But there is also an element of them not diverging too much. So, for instance, if the Fed was cutting once or twice, I think that would allow the ECB to do more this year. But in reverse, since we do not really see that policy panning out for the Fed, we think that the ECB will be a little bit more conservative in sticking to 3 cuts.
And how much stronger can the dollar get then, Giulio, in that scenario? I noticed this morning a note from HSBC, or some commentary from HSBC, saying there are limits to how much the dollar bubble, as they call it, may expand. What's your thinking?
I mean, there are for sure limits, but I think there is still room for the...
We're not there yet.
We're not there yet, exactly. I think there's still rumors for, margin for the dollar to go up. That, of course, position in a multi-asset situation, that position on investors in the UK or in Europe to benefit from that with exposure to US stocks. So technically speaking, we're a little bit more positive on US equities at the moment, precisely because of that FX component. So yeah, absolutely. There is still rumor, in my opinion. There is a limit in terms of fair value over the longer term and strategically speaking. But yeah, I don't think we're quite there yet.
So the upsides of a stronger economy for stock investors offset the downside of not getting those Fed cuts then, when it comes to your strategy for US stocks? Because you could argue if you're not going to get Fed cuts, then the markets are going to be disappointed. But you think if it's no cuts for the right reason, strong growth, then that satisfies stock investors?
Absolutely, exactly. That's what I think. So even though you're not going to see those cuts that might help US equities to be boosted in terms of discount rate, the economy looks still resilient enough, and the numbers are, there is some softening on the job market data, but the economy still looks strong enough in order to sustain through the earnings and to sustain through the expectations, still a decent rally on US equities at the moment.
On the European story, we reflect on the fact we have 7 straight days of gains, grinding out these record highs for European stocks in an environment where you're expecting maybe 3 cuts from the ECB. Where do you want to sit within European equities? Does it look a little stretched at this point? Has it got further to run? You've got that preference for US, but if you have exposure to Europe, where does that lead you?
Yeah, absolutely. So let me clarify that. Strategically speaking, and we've been positioned that way for some time, we do see value in European stocks over the longer term, just because of valuations. So by no means I think that European stocks valuations are stretched at the moment. Let's face it, they were starting very low, so they looked very attractive. They looked very cheap for a long time.
At an index level, this has further to run.
Exactly. I think there is that that rationale in a strategic basis. More on a tactical, say it's more like at the margin from my perspective. So we looked at U.S. stocks a little bit less favorably like 3 months ago. Now I think there is still more run there. But generally speaking, Europe, a more balanced approach towards European stocks in terms of strategic allocation, that's what makes sense for us at the moment, absolutely.
And where do you go in terms of getting gains, yields, I should say, fixed income? Do you want to be at the short end, front end? Do you have a preference for Europe, the US? Is there a cap that's in place in terms of the US, in terms of the issuance that comes through for the long end? Where are you honing in when it comes to fixed income?
Absolutely. So from a multi-asset standpoint, because here the things are a little bit different whether you're strictly speaking a fixed income portfolio manager but a multi-asset level, we're positioned in a way that's what I call the Schrodinger's cat strategy, so to speak, which is on the US front, since we're really not expecting any cat, we're not really positive on long duration. So we're more on the low end of the curve, not fully in cash, precisely in order to allow for both scenarios to happen, one of the two. So not having the cuts, but equally, if something goes wrong, so to speak, and we do see those cuts, maybe because the economic data are not as strong as we would expect, I would be positioned more on the 2-year end of the curve to have some of that duration, depending there on the US yield curve, and also allowing to have some margin in order to take credit exposure through income, simply because I'm not really seeing like credit spreads to go much wider at the moment because of, again, of the positive outlook that we have on the US economy.
Given that positive outlook, is it okay as a credit investor that I look at it as a yield story rather than a credit story? When do I need to start thinking about credit as a credit story? When do I need to start worrying about that side of the equation? Because at the moment, it doesn't seem as if investors are really concerned about that side of the fence.
I think that's fair. I mean, on the credit side, we are still like on IG, investment grade positioning, in order to recoup that, because the yield curve is still inverted. So in order to recoup that income stream, I think it makes sense to have some credit in IG at the moment on the low end of the curve to gain that, simply because you can afford it. Again, as I'm saying, I don't think that there's going to be like massive widening of spreads in the US at the moment. So we don't really we see that more as a tail risk, not our base case.
Okay, thank you so much. Thanks, Julia, for joining us. Julia Renzi-Ritchie, Vanguard's Head of Asset Allocation for Europe. We are, of course, as you've been made aware and you've experienced through this programme, we are live at the Qatar Economic Forum, powered by Bloomberg. It has started in Doha today. It kicked off around an hour ago, and we brought you some great conversations from there already. We've heard from the Qatari Prime Minister, as well as Poland's President, who is still in conversation with our Editor-in-Chief. You can watch that on the terminal. Other highlights of the day include the Malaysian Prime Minister, the HSBC CEO, and the President and CEO of Franklin Templeton. So plenty of good conversations coming to us from Qatar. Well, we're nearly done, guys, for this hour of the programme. European stocks not delivering much in the way of movement, but yeah, it's all about that macro data, I suppose.
I like the way you stress delivering, because Delivery Hero.
There we are, they're delivering.
It's top of your list. They're delivering. So they sold one of their businesses in Taiwan to Uber.
Delivered.
They've firmly delivered, and investors are rewarding them. Up 18%. It's the biggest gainer across your major stocks in Europe so far.
It's interesting listening to the Polish Prime Minister thinking about how he is spending his money right now. Rheinmetall under a little bit of pressure, but the order book absolutely chock full right now in terms of what they are expecting to come from European governments in terms of the
4% spending from Poland.
Yeah. The numbers are going to get bigger, and maybe they get bigger. That wraps things up. The Pulse is up next. The coverage will continue. This is Bloomberg.
Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua, live in Doha from the Qatar Economic Forum powered by Bloomberg. Now, here's what's coming up on today's program. The French President, Emmanuel Macron, tells Bloomberg he's open to seeing a major French bank acquired by an EU rival to boost financial integration. He spoke exclusively to our editor-in-chief, John Micklethwaite.
This is a totally new world, and we do need this new business model for the Europeans. More innovation, more investment.
Anglo-American announces a massive restructuring, exiting diamonds, platinum and coal in an effort to fend off a takeover bid from rival BHP. Plus, more than 1,000 corporate and government leaders descend on Doha for the Qatar Economic Forum. Don't miss any of our great conversations throughout the day. Now, first thing is first, it is inflation. A happy U.S. data week, actually. It's inflation week, so there's a lot going on in these markets. So first up, let's look at the European markets. You can see they're kind of trade-bound. Now, we did see similar moves when it comes to Asia. Investors, I guess, focused a lot more on the upcoming U.S. inflation reports. Now, if you look at dollar index, always good in these kind of weeks. You'll get volatility, dollar, but also maybe treasuries. Again, a little bit later today, I think the Federal Reserve Chair, Jay Powell, is also scheduled to speak. Consumer price index, though, on Wednesday, really projected to show moderation while still remaining too high to warrant rate cuts. So let's get on to the cross asset. You can see a little bit of a move sideways when it comes to European stocks. Now, I'm looking at treasuries. I'm also looking at S&P futures. Look at that. They're pretty much flat. Sterling 125.53. We have Brent at 83. And then the other thing that maybe we could watch out for is Japan's 20-year government bond yield rising to its highest level since 2013. Again, there's a lot of speculation, actually, that the Bank of Japan will try and reduce some of the debt buying amounts at its regular operations to try and help an ailing yen. Now, to talk about markets, but also opportunities out there, I'm delighted to be joined by Mark Nachman, the Global Head of Asset and Wealth Management at Goldman Sachs. Mark, thank you so much for joining us. I mean, I'm looking forward to our conversation here, but also on stage, where we talk about some of the opportunities out there and some of the main trends. Now, you're focused on private credit. What are you most excited about, and what are you worried about in this class?
Sure. Thank you for having us. So private credit, we think, is a big opportunity. I think it's a large asset class. I think when people talk about private credit, recently they really think about direct lending, which is senior secured loans to non-investment grade companies, which is a very big business. We think it's close to $2 trillion now. The risk reward in that business is unusually good at the current moment. We're talking 10% unlevered yields on securities that are high in the capital structure, pretty safe. But what I'd say is interesting is what else is going on around private credit overall. And so a couple of emerging themes in the business. First, private credit for investment grade assets, and so that could be securing against a collection of loans, a collection of consumer assets, and so on. And that is a big trend where especially insurance company pension funds are taking a look at the investment grade space, taking a look at going into private credit there, taking a liquidity and getting higher yields.
I mean, it's incredible. Like, private equity has really mushroomed, right? And if you look at, the totality of what it's worth, it's pretty incredible. Do you worry about valuations? And is that why there's opportunity, given the huge interest rate rises in a fairly short amount of space?
It's a good question. I think the key for private credit is that as you invest right now in private credit, you get the chance to do it at loan to values at what you think today's market valuations are. And the loan to values for these new originated private credit deals is pretty attractive. So I'm less worried about where new deals are getting struck, and I think you still get really good risk reward on those.
I mean, I know we're all eyes on the Fed, and it's moved markets almost like I've never seen before. I don't know if it's because they overpromised in December. Does that make a difference to attractiveness in private credit?
I think all eyes are on the Fed. This week will be interesting with the CPI number and retail sales coming out. We continue to believe that the next move by the Fed is a cut, not a hike, and I think Powell was pretty explicit about this last week. It's interesting, as you watch the economy and as you watch corporates, we've just come out of first quarter earnings. First quarter earnings have been pretty good, better than expectations, both on the sales and on the margin side. So we see corporates dealing quite well with this higher rate environment. So we feel pretty comfortable around the environment and around credit risk. Having said that, we're watching it. I think it's key in all credit strategies to be very focused on the best of credits, and that's what our team is very much focused on. I would say that the last 10 years or so have seen very little dispersion in terms of performance in private credit because everything worked well. I would say the next 5 to 10 years will be more interesting. We'll probably see more dispersion, and you'll be able to see, good credit work that teams have done, and a good differentiation between good investors and people who were just riding beta.
And Mark, you've also just inked a major deal actually with Mubadala in the space. Is that a template for more deals actually with sovereign wealth funds in the region?
Yeah. I think it's very interesting. We did a deal with Mubadala into Asia Credit, which is a growing part of our franchise. We also did a deal with OMERS, the Canadian pension fund for Asia Credit. So we think, we have, when people talk about private credit, they primarily talk about the U.S. and Europe, where we have very big businesses. We're building up an Asia private credit business. And together with Mubadala and OMERS, we're increasing our presence there, and we're pretty excited about their opportunity.
How excited are you about this region? I imagine that this is one of the things you have basically a goal of increasing your alternatives, right, quite significantly. Does the Gulf play a major role in this?
Yeah. Gulf is very interesting. We think it's a growth region. I think it's amazing in terms of the growth that's going on across a number of countries, and we think the region is actually interesting from a number of perspectives. I think people traditionally would think about the region as an exporter of capital, and that obviously played a big role with asset managers like ourselves. But I also think the region is becoming interesting from an investing perspective. I think one of the things to look at is the Middle East right now represents about 7% of the MSCI Emerging Market Index. We've done some research and believe that could go up to 10% depending on some other movements in the index, which will bring more international investors into the region. So when you look around the world in terms of growth, I think the region stands out. So we think there's interesting opportunities for us to invest in the region, have international investors come here as well. We're going to launch a number of strategies in the region. So we're excited about the region, both as a source of capital, but also as an opportunity to invest in local markets.
Mark, how difficult is it to choose where you base yourself in the region? Because there's a competition, and we spoke about it a little bit also just in the forum right now with the Qatar PM. There's a little bit, of course, between the UAE, Saudi, and even Qatar. How do you decide where you want to be based?
Yeah. We've been in the region for a long time, and we've been based in multiple locations in the region. So we continue to work with all the key countries, and are pretty excited about the opportunities set with all of them.
When you look back to private credit or some of the emerging trends actually in markets, I know you've just launched a real estate credit fund.
Yeah,
how do you break it down?
Yeah.
Like what sectors to invest in?
Sure. So real estate credit, very interesting. We just closed over $7 billion in funds to invest in real estate credit, which is a very unique opportunity set right now. We see the demand-supply imbalance in the business, as a lot of traditional lenders into the real estate market are full up with commercial real estate exposure, don't necessarily want to take more exposure at this point. But there are new, exciting, interesting projects getting done. And so the opportunity to lend into those new projects based on loan to values, based on today's value, is very attractive. So I think we saw a lot of investor interest in this strategy. We just closed this fund, and we're excited about investing it. We've invested, a good fraction of it already, and so we're well on our way on good returns on that fund.
So in what kind of geographies? Is it more geographies, or is it more kind of the actual real estate?
Yeah, so the fund is in OECD countries, okay. And so most of it will be U.S., Europe, Australia. Yeah. Will be the bulk of it. And a lot of it is in real estate plays in transition. Either there are new builds or changes of the functionality of the building, and so we see there, given how few people are lending to the sector right now, we see a really good opportunity.
Do you worry about anything being in a bubble right now? We talked about opportunities, but what is there something that you don't want to go near?
Look, I think we're watching, obviously very carefully. We feel pretty good about markets. I think as we talked a minute ago, we continue to believe the Fed is going to cut as its next move. We think that inflation will slowly come down, maybe not as fast as what people in the market expected at the beginning of the year. But we're kind of cautiously optimistic, I would say, about the market environment going forward.
Mark, thank you so much for joining us. That's Mark Nachman, the Global Head of Asset and Wealth Management at Goldman Sachs. Now, we're here, of course, in Doha at Qatar. The Qatar Economic Forum is underway. You're seeing live pictures of Haslinda's, of course, forum, the session, speaking with Malaysia's Prime Minister, Anwar Ibrahim. So much more to come here from Doha, Qatar. This is Bloomberg.
And I think we can, because why did I meet Khalid Mash'al and Ismail Haniya?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
From the world of politics to the world of business, Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
We've chosen France. It's a very, very important hub for us here on the continent. But I'd also say our people like living here. And one of the things in a competitive world for talent is we give our people much more latitude to work and operate out of places that they want to live.
Well, that was the Goldman Sachs Chairman and Chief Executive Officer David Solomon at the Choose France Summit. Now, several European energy giants are thought to be considering moving their primary stock listings to New York in search of higher valuations. Now, that includes the French oil major, Total, with Chief Executive Patrick Pouyanné saying the firm is seriously studying the move. While Bloomberg Editor-in-Chief John Micklethwaite asked the French President Emmanuel Macron if he would be happy to see Total make the move.
Not at all.
Would you,
and I would be very surprised. No, I wait for any confirmation. I understood it was rumors, so.
But it's interesting that it's tied to the idea that he would face extra ESG measures here that he would not face in America. And he thinks that would affect his valuation.
Do you mean that we are more serious than the US in terms of green economy and transition?
Yes, but you also, in your speech at the Sorbonne, you said, as I'll paraphrase, you said you cannot let decarbonisation and growth be enemies. And this would appear to be an example.
And this is my point.
Yeah.
But the point is just, we have to be sure when we regulate, we should not over-regulate.
Yes.
And I think now we have to deliver. We need in Europe much more investment. We have to cut red tapes, have more flexibility. The European Union is the most open place of the world. But you cannot survive if at the same time you have subsidies and overcapacities in China and protection in some part of the market, and Inflation Reduction Act and Buy American Act in the US. It doesn't fly 1 second.
So Europe has got to get tougher now.
But this is a necessity, not because we are protectionists, but just because we want to protect our economy.
The Germans do not agree with you about this.
I think it depends who in Germany and for which perspective. It's totally true that some German companies, when they are incorporated in China, for instance, benefiting from subsidies, not just German, European, American, their interest is probably to preserve that and to sell themselves their overcapacities in China to the rest of the world, and especially the European market. But the German economy's interest is totally aligned with the French economy's interests, meaning creating jobs, creating value, but just protecting your business and your people when they are attacked by unfair measures. And it's normal. It's part of the business. So for me, it's just a no-brainer.
Well, that was the French President Emmanuel Macron speaking exclusively with Bloomberg Editor-in-Chief John Micklethwaite in Versailles, France. Now, we'll have more of that interview a little bit later on in the program. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Well, Veolia shares higher this morning after a confirmed full-year profit forecast. Now, the French environmental services giant is benefiting from increased global demand for water and waste treatment, while a cost-cutting program has also boosted the bottom line. I'm delighted to be joined by Estelle Rakiadinov, the chief executive of Veolia. Estelle, thank you so much for giving us a little bit of your time on earnings day. So talk to us a little bit about some of the things that you've said you want to prioritize. Now, this is growth in the U.S., in the Middle East, and Australia to desalinize more water, but also for the treatment of plastics and the like. Have you put any acquisition targets on the radar?
So you're right, great result for the first quarter in terms of top line and bottom line, and a confirmation of all the strategic choices we've highlighted with our Green Up strategic plan, which you're right, focus our attention on 3 booster activities and 3 geographies. If I start with the 3 geographies, we're talking about the Middle East, about Australia, and the US. In the US, we already have $5 billion turnover. We've doubled this in the last 5 years, and we intend to double it again by the end of the decade. Because we are really based on a mega trend in the US, which is reshoring and the industries, microelectronics, lithium, gigafactories, as well as the health concern and, of course, the pollutant removal, typically the micropollutant in water. And both, we are very uniquely placed with a worldwide presence and patented technology to address those challenges. So very hopeful and very confident, actually, the future of Veolia.
Estelle, do you worry a little bit about a change in policy if there's a change in administration in the U.S.? And what does that mean for possible acquisition and possible growth in the United States?
So actually, as a chief exec of Veolia, I would say, irrespective of the result next November, the mega trend I've just highlighted, reshoring and building in America the chips manufacturing, as well as, say, pharmaceutical and strategic industries like that, or health. Those are mega trends which, whatever the outcome of the election, are here to stay. So for Veolia's business, it basically won't make a difference. And I've mentioned as well the Middle East, and you're in Doha, so I just wanted to highlight a big contract we've announced this morning, more than $320 million desalination plant in the Middle East, in ASEAN, which will be a worldwide most energy efficient desalination plant in the world. So innovation here is helping to save energy and water. That's exactly what Veolia is about.
There's also a little bit, of course, you have a long-term project to recycle EV batteries. Now, in the last couple of months, there's been a bit of a slowdown when it comes to electric vehicles in Europe and elsewhere. Does that affect your longer-term plans for that unit?
No, it doesn't, and you're right. We already have 5 units of battery recycling in Europe, in China, and we have some project in the US as well. And we are finding back the lithium, the cobalt, the nickel, which are within those batteries, and scrambling them, if you want, to put them back into another loop of production. The reason why I mentioned that is, of course, a unique technology which helps us to do that, what we call hydrometallurgy, which means that instead of importing nickel, cobalt, lithium, and all the strategic metal, we are finding them in our wasted batteries, the batteries from electric cars, the batteries from cell phones, which means that we're talking strategic autonomy here and independence. So again, we're not finding it only in electric cars, in other stuff. And strategic independence is something which is at the forefront of, say, EU legislation. And actually, there is an obligation for gigafactories by 2030 to have a certain amount of recycled of those metals within the gigafactories. So it's supporting our growth in this industry. So globally, the answer to your question is no, it won't have any impact. We still are very confident about this part of the business.
We're almost running out of time, but I also wanted to ask you about one of the resolutions that was adopted at your AGM last month, which is basically capping some of the shareholder rights to 10%. Is that because you're worried of an activist investor, or have you been approached by an activist investor?
No, it's actually the opposite way around. It's a way to protect shareholders from potentially taking only a small share of Veolia and not doing a total takeover, and therefore preventing the other shareholders from benefiting from the premium. So it's a pro-shareholder resolution, and that's why it was very, very well voted at our AGM. Actually, 86% of our shareholders voted pro this resolution.
Thank you so much for joining us today. Always a pleasure to speak to you. Estelle Pakianov, the Chief Executive of Veolia. Coming up, of course, Bloomberg Intelligence says takeover bids could be on the cards for France. Our conversation with our Editor-in-Chief.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Now, the French President Emmanuel Macron tells Bloomberg he's open to seeing a major French bank acquired by an EU rival to boost financial integration. He spoke exclusively to our editor-in-chief, John Micklethwaite.
This is a totally new world, and we do need this new business model for the Europeans. More innovation, more investment.
Anglo-American announces a massive restructuring, exiting diamonds, platinum and coal in an effort to fend off a takeover bid from rival BHP. Plus, more than 1,000 corporate and government leaders descend on Doha for the Qatar Economic Forum. Don't miss any of our great conversations throughout the day. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in, you've guessed it, Doha, Qatar. Now, a couple of things that we need to watch out for. GameStop and AMC Entertainment, two of the most prominent companies from the meme stock rally. Remember that, 2021, both surging in U.S. pre-market, continuing Monday's rally. I'm looking at GameStop, we're gaining 39%, AMC gaining 39%. Now, it follows a return to social media by Keith Gill, yes, known as Roaring Kitty. He originally rallied day traders on Reddit in an effort to squeeze short sellers of GameStop as shares in the company have since lost more than 60% of their value, and AMC is down more than 99% over the same period. Now to our interview of the week, and Emmanuel Macron says he'd be open to seeing a major French bank being taken over by an EU rival in order to spur deeper integration. Now, we spoke exclusively with the French president as he hosted a global investment summit in Versailles. Well, he told our editor-in-chief, John Micklethwaite, that the region's only chance to go toe-to-toe with China and the U.S. is to better protect its interests and reduce regulation.
We have to completely reset our model. I think now France clearly is one of the leading economy. We are number one in attractiveness. We've been number one during the past 5 years. And if you take job creation, growth, we are one or second in the Eurozone.
Do you think you're being held,
so this is my point.
By the...
We are here. Now when I take Europe, and especially the EU as a whole, but it's true as well for UK, we have this issue in terms of business model. Why? Because we had low-cost energy thanks to Russia, production thanks to Central and Eastern European countries with quite low costs, a market for exports, China, and a geopolitical umbrella, US. These pillars are being completely revised, totally.
Yes.
And it's no more valid. So we have to reinvent. What and how? By creating much more value on our own, by being much more innovative, by creating much more jobs and jobs with value, good jobs, I would say, on our continent. The key point is deliver much more innovation and productivity policy, public and private. So the second key reforms is to accelerate decarbonization and especially our electricity policy, because through renewables and nuclear energy, we can deliver low carbon, sovereign, and low-cost energy, which is much more than importing gas and fossil fuels. Third, we need much more investment based on common budget, and in my view, I mean, based on public reports and figures, we need 1 trillion more in terms of budget, in terms of spending. And in parallel, we have to make the capital market union a reality, which is not yet the case.
Can I come on the capital market union? Because you have here an example. You have BNP.
Yeah.
Now probably Europe's and definitely the Eurozone's most successful bank, worth $80 billion. But you know you're entertaining these people like JP Morgan and so on. JP Morgan is worth $550 billion. It's 9 times as big. Bank of America, 4 times as big. And the reason why is BNP Paribas cannot expand throughout the European Union and take over other banks.
This is very true. We have several issues.
You would like to see BNP take over one of these, take over a German bank or an Italian one.
I mean, we do need a consolidation, but we do need as well an actual domestic market as Europeans, which is not the case. We have to deal with 27 regulations. You know, energy, finance, and telco are the key sectors where single market doesn't exist. It was a choice at the very beginning. I do agree that we have now to open this box and to deliver a single market approach. But it's much more efficient. So our view is that now we want to elaborate a Franco-German consensus on capital market union to have a single system of resolution, a single supervision, and a much more integrated capital market union.
But would you be happy with, say, Spain's Santander coming and buying Societe Generale as part of that?
It's part of the market, but dealing as Europeans means that you need consolidation as Europeans.
So it could be cross-border mergers in both directions.
But this one is for banking union.
Yeah.
It's already on track. Now we have to do it for capital market union, which is broader,
more difficult.
and even more difficult. But we started to do so at a political level during the last council, and I do believe that we can find a Franco-German agreement. But why? I want you to just understand the challenge for us. 75% of our financing as Europeans go through banks and insurance. So we need much more consolidation, but we need a clear circulation of the savings all around the place. This is the first objective, to be much more efficient and to be sure that our savings will be invested in the right sectors and the right geographies. Second, every year, 300 billion savings goes to finance the US economy because we are not attractive. So in parallel with this capital market union and the simplification, having an actual single market, we clearly need the same level playing field as the US in terms of financing, which means when you take solvency and Basel, as long as it's not implemented by the US competitors, it should not be implemented by the European competitors. Otherwise, this is a killer for risk-taking, because these regulations just prevent you, our banks, from investing in equity, which is exactly what we need. And if you take the key driver of this difference between the US and Europe, the key driver is the fact that the US economy innovated and invested much more in equity and innovation than the European economy.
The French president there, Emmanuel Macron, speaking exclusively with Bloomberg editor-in-chief John Micklethwaite, who joins us now. So, John, first of all, congratulations on the interview. It was extensive. You got a lot of news out of him. What was the thing that struck you the most?
I think, well, first of all, to apologise to the viewers to see 5 minutes of me and then I reappear. But I think the crucial thing is Emmanuel Macron has concentrated largely up to now in trying to change France. I think now he is aiming at something much bigger, which is to change Europe. And it's all about, from his perspective, Europe has not thought about China and America. It has not fought against them using their tactics. He thinks America is cheating, it's using the IRA. China is always pushing things through. Europe, in his view, has to kind of butch up. It has to get much stronger and tougher. And if that means making certain changes inside Europe, that's part of it. But it's all part of this idea that he wants to change Europe as well.
But John, I was really surprised, actually. He told you that, he'd be fine with a foreign bank coming in and getting one of the French banks. I mean, this is France. France always kind of tried to protect their industries or their jewels.
I have to admit, I expected him. I asked him whether he would presumably support the idea of BNP, Europe's most valuable bank. If it went to go and buy an Italian or a German bank, that sounded wonderful. And he said yes. When I said, well, what happens if Santander comes back and they bid for Société Générale? He said, well, that's fine too. And I think that is a change, because you look at Macron's history up to now, you know, he always talked this big European talk, but in practice, he's still usually been French. If you go to Berlin, they will say, well, look, Emmanuel Macron always makes these big speeches, but he's someone who blocked a supermarket takeover on the basis of national security. He won't let the Spanish do their power construction. He blocks another Canadian thing. He's always, when he talks about European champions, he's thinking about French champions. Well, in this case, not. You know, he's saying, look, I want banking union, I want capital markets union. I'm prepared to put all these things into play, and I think that is a change. I would argue it's the right change. It's long overdue. If you look at those banks, they're tiny. BNP has done amazingly well. It's only worth 80 billion. I think JP Morgan is worth 550 billion. Bank of America, 300. These are many times bigger, and Europe has fallen behind. He does want to compete.
John, I mean, it's complicated, or at least the chief executives of big oil majors will tell you it's complicated being listed in France or in the UK. Yes. And so we heard from Total saying he's also looking at possibly listing to the US. What did the French president have to say?
He said he was very disappointed by that, in a way that probably I would not like to be Patrick Bouillon hearing that disappointment. But he also said he didn't expect it to happen. And the problem there is what Total is saying is, look, we love France, that's our home, but if we move to America, we get away from a lot of that ESG stuff that Europe is doing, and our valuation will go up. When I say move to America, take their primary listing there. And that is the kind of core of it. In this big speech at the Sorbonne earlier, Macron delivered this sort of fusillade against Europe and how useless it was and how sclerotic and it needed to change. But he's always included climate as one of the areas where Europe should both be competitive but also hold very firmly to its principles. And in this case, he doesn't show any sign of backing down. So Total isn't in any better situation. There's not an obvious way you can square holding people accountable for green stuff whilst at the same time wanting to promote. There's going to be difficulties for banks, for energy companies and others.
I mean, a lot of the other European heads of state will say, well, Macron's a dreamer, right, because he's talking about integration. Like, does he have much support with the rest of Europe?
I think the answer is he has a kind of, potentially, yes. But he has a huge amount of skepticism, a little bit because of his habit of making these big speeches. But secondly, also because people didn't trust France. Well, maybe, look, he is doing stuff on mergers now. But underneath it all, you've got this real problem that everyone's looking at their own interests. And his big block is the Germans. Because when he says, let's be tough on China, Olaf Scholz suddenly looks over his shoulder and wanders off somewhere else. There is not the same, and apart from the else, there is not the chemistry between Macron and Scholz that there have been historically between Franco-German leaders. So his ability to push this through, he will have to form a coalition of other people. And the one thing he has going for him is that he is basically right. At least in one respect, is Europe is falling behind. You know, France has grown more than most other European countries. It's still only grown at half the rate that America has. That in the end, is not a competitive position.
John, I also want to talk about Ukraine. Now, you just got off stage where you spoke to the Polish president, President Duda, and this is what he had to say on Ukraine.
We must not allow that Russia wins in Ukraine. Once again, let me repeat. The free world must not, I believe, allow Russia to win the war in Ukraine.
Well, that was, of course, the Polish president, President Duda. And John, he was very clear. We can't allow Russia to win this. But, you know, on the ground, it's not that easy. And again, a lot will have to do on who wins the presidential election in the U.S.
Exactly. I pushed him quite hard on Donald Trump because he has always been a friend of Donald Trump, if we can put it that way. He went to go and see Trump the other day, but you have Vladimir Putin patently. One of his main strategies is to wait until Donald Trump comes in the White House in the hope that he will get a better deal. And the reason why this is so difficult for people like President Duda is, on the one hand, you know, he instinctively feels comradeship with someone like Trump. On the other hand, from a Polish perspective, if Trump gives in on Ukraine, what does that mean for other places? Because what he is saying, very visibly, what Duda is saying, is if Ukraine goes, us, the Baltic states, we will be the next people in Vladimir Putin's diet.
Thanks so much for joining us. That was our Bloomberg editor-in-chief, John Micklethwaite, and I think he's interviewing a couple of other heads of state this week. Now, let's also recap Tencent's earnings, which were reported a short while ago and met estimates. Revenue, 159.5 billion yuan, a touch above estimates. Again, Naspers also gaining on Tencent earnings. So Naspers, just a reminder for those that don't know the story by heart, owns about 25% of Tencent. So pre-market, actually not pre-market, Tencent gaining some 30%. Coming up, we also have our exclusive interview with the U.S. Treasury Secretary, Janet Yellen, on trade tensions with China. That's next, and this is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's been actually a very long process, and especially in the past few weeks, we have seen some momentum building, but unfortunately, things didn't move in the right direction. And right now, we are in a status of almost a stalemate. Of course, what happened with Rafah has set us backward a little bit. Probably there is no clarity how to stop the war from the Israeli side. I don't think that they are considering this as an option.
Well, that was Qatar's Prime Minister speaking at the Economic Forum here in Doha. Now, staying with geopolitics, and the Treasury Secretary, Janet Yellen, says China could always retaliate against any steps the U.S. takes to protect its critical new industries. Now, Yellen declined to confirm Bloomberg reporting that the Biden administration is about to hike tariffs on Chinese goods, including electric vehicles. Well, she told us exclusively about the president's thinking on trade tensions.
He believes it's unacceptable, as I do, to be completely dependent on China in these areas. And he wants to make sure, given that China is really not playing by the rules in the sense they have enormous subsidies in critical areas of advanced manufacturing, has resulted in overcapacity. He wants to make sure that the stimulus that's being provided through the Inflation Reduction Act to support these industries, and these are industries that are creating good manufacturing jobs in parts of the country that have been overlooked or have suffered from deindustrialization in the past. The president wants to make sure that he protects these investments. And I don't want to get ahead of the 301 review on tariffs, but this is a commitment that President Biden has made, and I agree with it. I was in China just a couple of weeks ago and made clear that we would not allow Chinese overcapacity to harm our emerging industries.
Does the U.S. want a trade war, though, with China?
We believe that we should have a deep and productive, and that we do in most areas, trade and investment relationship. We're working to stabilize our economic relationship. We do not wish to disengage from China economically, but we do think that the playing field should be fair. And China engages in unfair practices like massive subsidies of industries they've decided are critical. And those are cases where we will act to protect ourselves.
We've seen Beijing in the past, though, respond, and it's become tit for tat. Are you expecting a response? Could they go after Tesla or maybe American farm products?
Well, President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
Well, that was the U.S. Treasury Secretary Janet Yellen speaking exclusively to Bloomberg's Anne-Marie Herter. Now, coming up, we have many more corporate news. It's a major battle, also the mining industry. Anglo rejects another takeover offer from BHP, proposing instead to exit its coal, platinum, and diamond businesses. We'll have the latest next, and this is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Now, Anglo-American is planning one of the biggest shakeups in its 107-year history. The miner says it's planning to exit its diamond, platinum, and coal businesses as it seeks to fight off a takeover approach for rival BHP. Now, let's bring our Bloomberg Commodities editor, Brian Wingfield. Brian, so what exactly is happening here?
Hi, Francine. Well, Anglo is basically saying that it's willing to slim down its operations in order to fend off a bid from BHP. This would be BHP has offered a takeover twice already, and Anglo is essentially saying it will do some of the things that its investors have asked for in the past in order to not accept that bid.
So why does BHP want Anglo so badly? Is it all about the copper?
It is all about the copper. Copper is a key element to the energy transition, and Anglo has a large copper mine, and BHP effectively wants that. Anglo has previously said that the offer that BHP made was too low, and so what it's doing now is trying to see if shareholders will essentially buy into some of its plans to slim down its operations to keep the company a little bit more focused as it goes forward. So what it's doing is
So, Brian,
saying
talk to me about exactly what happens here. Right. Sorry, Brian, I cut you off.
Sure. No, Anglo is saying that it will divest its diamond and platinum and coal mining operations, and it's also agreed to slow spending on a fertilizer mine in England. This is something that investors have wanted in the past, and essentially Anglo is saying that it will go this route in order to fend off the merger bid.
Thank you so much. Our Bloomberg Commodities editor there, Brian Wingfield. Now, the Qatar Economic Forum, powered by Bloomberg, started in Doha today. We've, of course, heard from the Qatari Prime Minister, Poland's President, and the Malaysian PM. Coming up next, the HSBC outgoing Chief Executive, but also Chief Executive Franklin Templeton.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station, and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that people living, the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Cranny with Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Trade tensions. Treasury Secretary Janet Yellen tells Bloomberg that China retaliation against U.S. tariffs is always a possibility. Anglo-American exits diamonds and platinum in an effort to fend off a takeover bid from rival BHP. Plus, the Qatar Economic Forum kicks off in Doha. We have exclusive conversations with global leaders in business and government. Good morning, Manus.
Danny, good morning. I've been waiting for a long time to say this, but Roaring Kitty is back, and so those meme stocks fly. Keep an eye on GameStop and AMC, up 70% yesterday, up another 30% this morning. So is meme stock mania back? We'll talk more about that in a moment. There's your GameStop, up 39% pre-market. I just sort of like this story. It's just all a bit bonkers. Somebody appears on X and bang, these stocks go bid like mad. There's AMC up 38%. 10-year yields, we're going to see a little bit more narrative around what's happened. Yesterday, we saw the New York Fed inflation expectations for 1 year and 5 years. So the short term and the medium term spike a little bit higher. That unseated the bond market a little bit ahead of the PPI, the retail sales, and the CPI. That compilation narrative along with some of the other retailers. Bonds are down by a tick this morning. JGBs, they are all feeling this momentum higher in terms of yields, certainly on 30 years, decade high there. So the question is the next move from the Bank of Japan, they pulled back on some of the QE, the bond buying that they did yesterday. Is the next move a shorter, sharper move higher in rates earlier than the market had anticipated? It's not supposed to be this way. This is all about closing the yield gap. Danny, good morning.
Good morning, Manus. We have some breaking news to go through. We had been expecting this, and we have indeed got it. President Biden is hiking tariffs on things like Chinese chips, minerals, and EVs. The changes, Manus, they're going to impact about $18 billion in current annual imports. I know you have some of the specifics with you, but this is more targeted than what Trump has proposed, which is a 60% flat tariff from Chinese goods.
Indeed. So this is pretty much in line with reporting that we had over the weekend, which was electric vehicles are going to go to 102.5%. We know that selling EVs for China here was always going to be difficult. They're already at 27.5%. That goes to 102%. Aluminium and steel, Danny, goes to 25%. So again, this goes back to what Terry Haynes said over the weekend, which is this is a lot about noise. But it is about an unsettling future in terms of the landscape, the geopolitical landscape. You're going to see them raising tariffs on ports, cranes, medical products, and increases on steel and aluminium, as I said.
Yep. So now we have to debate what is symbolic, what is actually impactful. Let's do that with our very own Bill Ferries. Bill, good morning to you. So we have these plans from President Biden. He's going to talk about them more in detail in a speech today. What about them do you see as symbolism versus actually impactful?
Well, that's exactly right. It is a broad swath of imports that we're talking about here, but some of them are purely symbolic. As Manus mentioned, the tariff on EVs, Chinese EVs coming in 102.5%. That's a big headline number. They're currently, I think, at 27.5%. But as you two know, you cannot buy a BYD or other Chinese electrical vehicle in the United States at this point. So that is very symbolic. What's interesting is some of these other ones, including the 25% tariff on chips, and then on port cranes, on medical equipment, including PPE. These were things that the U.S. badly needed and ramped up imports of during the COVID pandemic. But President Biden's goal here, what the White House is saying, is that they want to really give a boost to domestic manufacturing. Frankly, they also want to send a political message. And what we heard from National Economic Council Chair Lael Brainerd was that her quote was that China is too big to play by its own rules. But again, it's all happening in the middle of a political campaign, and that is really the big context looming over all of this.
Yeah, and just to quote Terry sort of specifically at Pangaea, he says, it's about the signal. The high geopolitical risk is reshaping U.S. economic policy. And we're all distracted with the Fed. So it's like, look over here, and perhaps there's something more malevolent over there. We caught up with the Treasury Secretary Janet Yellen yesterday, and she spoke to Bloomberg about taking major retaliatory steps against China.
President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
It's my favorite saying, but the road to hell is paved with good intentions, so they're hoping it won't be a scalable response from China. Is that likely? Is it just going to be tit-for-tat drama?
Well, I think the key word there from Secretary Yellen was significant response. Listen, as you mentioned, we're talking about $18 billion in imports. The U.S. imported over $400 billion in goods from China last year, so a relatively small amount. I would expect some kind of a response for sure from China, even though they knew this was coming. Janet Yellen signaled it to the Chinese when she was visiting the country, I think a month or 2 months ago. So this is not a huge surprise. We're getting the details now. But yes, I think China will make some kind of a response. But as Janet Yellen said right there, will it be significant? That's going to be the big question. It may be more symbolic, like some of these tariffs the Biden administration is proposing now.
Yep, certainly. Bill, appreciate it. That's Bloomberg's Bill Ferries. And perhaps because this was largely expected, not too much of a reaction from markets, basically where Manus first flagged them to start the morning. But should investors be pricing in a change in global order? Marvin Barth, founder of Thematic Markets, writes, the biggest threat to the global economy this year comes from intensifying geopolitical disorder, or what I've termed global entropy. Marvin joins us now. So Marvin, here we go again. Yet something else to add, perhaps, to global entropy. What is it, and why are we not as concerned as we should be?
So global entropy, very, very simply, is what a lot of people have called the fracturing of the post-war liberal order. And it's been going on for 30 years, but it seems to have really accelerated in the last year or so. And, you know, I would take a very different view of those trade sanctions. They're not symbolic. They are exactly part of an ongoing, undeclared, non-kinetic war between the U.S. and China. Yeah, you're not importing a lot of EVs now, but the point is you don't want to, and you're trying to protect industries that you feel are critical in times of national emergency, including warfare, by the way, that you want to develop in the U.S. So these are basically infant industry protections to try and develop those industries in the U.S.
Marvin, good morning. Danny came in this morning and she said she opened your blog and she went, oh, Marvin's taking a bit of a turn, a dark turn. So how dark is the turn? Because you talk about Fed policy error, expanding global disorder, direct confrontation between the U.S. and China. What is the most manifestly real issue, and what is the most pragmatic hedge that I can afford without squandering cash?
Yeah, Manus, look, you know that I've been perhaps the most bullish analyst out there and right about the last several years. I said, we're going to get much higher interest rates because the economy is going to boom and everything's going to be fine through that. This year, I see so many different things coming together that are non-economic, the only one of which is, perhaps the Fed and its potential policy errors being economic, that's what's really scaring me. And, I think on the geopolitical front, the key issue is, if you look at this global entropy that's been taking place over 30 years, it's been a slow, gradual process. In the last year, 2 years, we've seen, an invasion of a state in Europe. We're seeing a potential war in South America. We are seeing increasing risks of a war in the Pacific. We see the potential for Israel and Iran to get into an all-out war. This is showing you that global entropy has gotten to a point where actually things are potentially becoming chaotic, i.e. you're going to start to see nonlinear developments there.
Okay.
And I would also say that you should think about these as linked events. So how do you hedge those, I think, is the key question.
Okay, so tell us, Marvin, because in the world you're describing, I mean, you have here 10% odds of World War III. I'm reading this, Marvin. I said this to Manus this morning. I'm almost like, who even cares about financial markets at this point? It's almost apocalyptic. Yes. So, I mean, what do you do with that?
Okay, so I think, the way you have to approach this is almost looking at like a venture capitalist, right? A venture capitalist is going to bet on 10 different things that most of them they know are going to fail, but they're only going to invest in things that if they do pay off, they're going to pay off so big, they're going to pay off for the rest of the portfolio. And that's effectively the process you need to do here. And right now, options pricing, swaptions pricing, volatility pricing in general is so incredibly cheap. We're at near historic lows that actually you can go out and buy a lot of these options and build a basket of them that maybe all of them aren't going to pay off, but you can pay 1% of your portfolio value and still get like 10, 20 times payout that would offset a significant loss on the rest of your portfolio. Those opportunities are out there right now, but they won't last forever, so you should be grabbing them.
And you are particularly focused, I'm trying to distill a pretty meaty blog, but you are particularly focused on the post-election period, not just because of potential political, social issues, but also around the reversal of the Fed. Quantify the closing period, November 7th through to Deck 31.
Yeah, I'm actually much more worried about before the election. If you look at volatility pricing, everybody thinks the election is going to be this big issue. I'm not actually that worried about the particular election. We've had both of these presidents before. This is not a surprise. What is more of an issue, I think, is that the Fed keeps telling us that they don't have to worry about inflation. It's going to come down. We're going to get another signal, I think on Wednesday, CPI comes out. Core inflation is now running at 4.5%, more than double the Fed's target, okay? They are not going to be able to backtrack. We're much more likely to see a hike rather than a cut.
Well, Marvin,
and I think that's going to be a surprise for markets.
And you write partially, the reason they're not doing it is because of politics. Jim Bianco, I think, laid this out really well. There's a difference between being political and partisan. Which do you think the Fed is being right now?
No, Jim has it exactly right. Look, I'm a former Fed economist. I can tell you the Fed is not a partisan political animal. I don't think anyone there is thinking we want, Democrats versus Republicans or vice versa. But what I do think that they're thinking is that they probably first of all, I think this is based in their own inherent beliefs about the economy, but that's being augmented by, I think most of them probably are scared of the idea of Donald Trump as president. And so if they can try to avoid that, they'd like to, and it fits with what their models are saying. So I don't think it's an explicit or even conscious political bias, but it comes out in their policy.
Okay, Marvin, we have a lot to chew on. Try and take a brighter road, Marvin.
I wish.
A bit of weight off those shoulders.
It's too deep in.
Because that blog was heavy going. Marvin, always great to see you and get your take. That is Marvin Barth of Thematic Markets. The stories trending on your Bloomberg terminal this morning. This is what we've got for you. French President Emmanuel Macron says he'd be open to seeing a major French bank being taken over by an EU rival to spur deeper integration. Macron spoke in an interview with Bloomberg News editor-in-chief John Micklethwaite on the sidelines of Choose France summit in Versailles.
dealing as Europeans means that you need consolidation as Europeans.
So it could be cross-border mergers in both directions.
This is a totally new world, and we do need this new business model for the Europeans: more innovation, more investment, single market and capital market union, and a relevant trade policy.
U.S. Secretary of State Antony Blinken arrived in Kyiv earlier today. He's there to reinforce U.S. support after delays in billions of dollars of military aid prompted fears that the U.S. would abandon its partner in the face of Russia's invasion.
Poland's president says Russia will launch additional attacks if its forces aren't prevented from victory in its war on Ukraine. Duda spoke with Bloomberg at the Qatar Economic Forum in Doha.
We must not allow that Russia wins in Ukraine. Once again, let me repeat. The free world must not, I believe, allow Russia to win the war in Ukraine.
Speaking of the Qatar Economic Forum happening right now in Doha, Bloomberg's Jomana Bersetchi is speaking to the finance ministers of Qatar and Saudi Arabia, as well as the chairman of the Islamic Development Bank Group. If you want to tune into this, you can go and watch on LiveGo on your terminal.
Comes to fiscal sustainability, for the country.
Your Excellency, let me ask you about Saudi Vision 2030. We're more than halfway through, and there are some very notable.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It is Bloomberg Brief. I'm Manus Granny alongside Danny Berger here in New York. To the Qatar Economic Forum, it's underway in Doha, and the event brings together government officials, key business leaders from around the globe to explore the issues driving the boardroom conversations and the challenges ahead. Jennifer Zabazaja is on the ground at the conference. Jen, good to see you. Shame not to be there this year, but geopolitics must be front and center. You've had the Polish Prime Minister, you've had the Qatari Prime Minister. What is the roadway to a de-escalation? How much of that is absorbing this morning's conversation? How are you?
Yeah, morning to you, Manus and Danny. Yeah, I mean, that's really dominating a lot of the conversations that we've heard this morning. You talked about the Polish president who we heard from. We also heard from the Qatar Prime Minister, who, of course, Qatar has been very involved in potential negotiation talks as pertaining to the Middle East. And what he said that the talks had actually hit a stalemate, which I think was a surprise to many people over the past few weeks, considering Qatar's position. But yes, of course, geopolitics is front and center here at the Qatar Economic Forum. But there's also a number of issues that a lot of countries are facing here. There are climate emergencies. There's also, of course, economic debt distress that a number of African countries where I live are facing. So these policymakers, these leaders, these CEOs are really trying to convene and talk about what are some of the solutions that they are coming up with, and how could they potentially work closer together instead of working in bilateral and on their own terms.
Okay, Jen, great to see you. I look forward to the next couple of days of broadcasting and panels. And speaking of which, let's now give you a little bit of a taste of what's going on at the moment. We have the Minister of Finance for Qatar, along with Al Judaan of Saudi Arabia, and the Chairman of the Islamic Development Bank in conversation with Jumana Basechi.
Only in the past 7 years, we moved from 10% to about 37%. That's significant. Our non-oil GDP has now reached the stage where it actually represents about 50% of our economy. Our unemployment, when we started Vision 2030, was about 12.3. Today, it achieved actually the target for 23 of 8%. Now it is 7.7. We are very close to our 2030 target of 7%. Women participation, you mentioned, we had a target of 30% by 2030. We achieved that in 22, and we are moving now to 36%, and we upgraded that target. Employment in the private sector, because generally in the GCC, governments used to be the employer, the key employer. That is changing. We have 2.3 million employees now in the private sector, the highest ever in the Saudi history. And I can go on, but there are real serious results that are giving us clear momentum. We are not complacent. Obviously, we need to push through the momentum of reforming and transforming the economy, but we see the results. The last point you mentioned, and I'll try to be as short as I can. Obviously, when we started, we did not have COVID. We did not have inflation. We did not have incredibly high interest rates around the world and cost of funding. We did not have the war in Europe. We did not have the war in the Middle East. We did not have the disruptions in the Red Sea. We did not have the disruptions in the supply chain. And that then, all of these collective shocks that are facing the world calls us also to reprioritize, to look at what we are doing and how can we actually optimize what we are doing, optimize our plans. It's not actually the funding that is the constraint. The funding is one part, but it is not the part, to be honest. It's actually the economic leakage. Because if you spend under the current circumstances of serious inflation pressures around the world and serious increasing cost of funding, you are just going to cause two things. One, more inflation and overheating your economy. But second, which is also...
And you can continue to watch this conversation and others at the Qatar Economic Forum live go on your terminal. Okay, coming up, diamonds aren't forever. Anglo American is planning a massive restructuring to fend off its rival. We're going to have more on that next here on Bloomberg.
names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Anglo American is exiting its diamond business to become a copper giant. The CEO says that he expects the massive restructuring to last until the end of next year as the British miner attempts to fend a takeover from its rival BHP. Brian Wingfield of Bloomberg joins us now from London on more. So Brian, what are they selling and how does this help them prevent a takeover?
Well, what's happening here is BHP wants Anglo because of its copper business. Copper is a key metal for the energy transition, so this is something that's very valuable to any mining company. Anglo is a bit of a conglomerate that's got a lot of components to its operations. So what it's doing to fend off the takeover bid is saying something that investors have wanted for some time, which is to streamline some of its operations and exit its diamond and platinum and coal mining businesses.
Okay, well, the stock is reacting this morning. There you go. There's Billy's down 1.6%, and Anglo-American also a little bit lighter. This battle is not done yet. Brian, thank you so much, Brian Wingfield, on the Anglo-American BHP saga. Coming up, much more coverage from the Qatar Economic Forum in Doha. Context matters on Bloomberg. Good morning from New York.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on
that we are only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
DOJ or other authorities
could face bigger challenges next.
It was going to keep bringing World Cup.
This is a three
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond. From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
President Biden hikes tariffs on a wide range of Chinese imports in an election year bid to bolster domestic manufacturing and critical industries. Anglo American exits its diamonds and platinum business in an effort to defend the takeover bid from the rival BHP. Plus, the Qatar Economic Forum kicks off in Doha. We have an exclusive conversation with global leaders and businesses and government. Danny, good morning.
Manus, markets are unmoved this morning, and why would you be? We get PPI today, CPI tomorrow, then we get retail sales. Not to mention we get some individual company earnings of the retailers sprinkled in there. So stocks, unchanged. U.S. 10-year yields, unchanged. Yen, this is also unchanged. Interestingly, because the bond market is moving in Japan, 10-year yields are at their highest level in nearly a decade. But the yen, again, isn't reacting to this. The reaction is that Japan might do what they did earlier in the week, that is cut some of their bond sales. Man, is perhaps the most interesting thing in all of these markets is the return of the meme stocks. GameStop yesterday up some 75%. I think it's up again this morning pre-market, something like 40% to start the show. Manus, I love this because it's so stupid. We were talking with Marvin Barth earlier this morning, and it was just all doom and gloom and so depressing. I kind of like the return of the silly meme traders.
No, listen, Marvin was fairly doom-laden in terms of geopolitical risk. We've had more tariffs announced this morning, which various people have said is a little bit more of theater rather than actual impact. But you're right, GameStop is roaring. Let's have a look at some of these stocks this morning. So we've got AMC up 42% at pre-market, and you have GameStop up another 43%. And this all goes back to, I love this, what is it, Roaring Kitty?
Yeah. For those,
she doesn't mean Roaring Kitty impression, by the way, but we won't do that on TV.
Please don't make me do that, man.
I won't make you do that.
For those who are unaware, basically Roaring Kitty, how do I describe this? He posted a meme of a guy going like this to going like this with a little game.
So this is Keith Gill.
Yeah, Keith Gill, and basically he had been silent for a while, so he's come back and everyone's trading this. And look, the thing is you could say, okay, are we back in the euphoria era of 2021? I mean, we're not, by any stretch of the imagination. Consumer sentiment is in the gutter. People don't have that pandemic money anymore that they can gamble with. So it is different this time. In the general environment, people are back at work, but it is interesting nonetheless, the firepower that this man has, literally just by tweeting one thing.
I mean, if Roaring Kitty told me to go and actually, call my financial advisor, I would believe Roaring Kitty.
You do the Roaring Kitty trade, man.
I mean, I want to put it in context. GameStop in 2021 surged by 2,000%. So we're talking about 110, 115%. It's a rounding error at the moment. So we'll keep an eye on those stocks for you through the morning, that's for sure.
Yeah, well, the other thing we have to keep an eye on, Manus, is we've been long awaiting, you mentioned this, the announcement of tariffs from the Biden administration. We have it. Biden's going to be giving a speech today on Tuesday where he lays this out specifically. So we can get into some of the details. The big picture of this, Manus, though, is a sweeping tariff on things like chips, minerals, and EVs, and it's going to affect about $18 billion worth of current annual imports.
And I think for context around this, we did some great reporting over the weekend. The electric vehicle imports from China, tariff 102%, but you can't really get your hands on a Chinese electric vehicle. That goes from 27%. Steel and aluminium goes to 25%. Semiconductors doubles to 50% by 2025. Now, we caught up with the Treasury Secretary, Janet Yellen, or I should say, Amory Hordern caught up with the Treasury Secretary, Janet Yellen. That was yesterday. China could always retaliate against the steps taken by the US to protect its critical industries. And this is what she had to say.
He believes it's unacceptable, as I do, to be completely dependent on China in these areas. And he wants to make sure, given that China is really not playing by the rules in the sense they have enormous subsidies in critical areas of advanced manufacturing, has resulted in overcapacity. He wants to make sure that the stimulus that's being provided through the Inflation Reduction Act to support these industries, and these are industries that are creating good manufacturing jobs in parts of the country that have been overlooked or have suffered from deindustrialization in the past. The president wants to make sure that he protects these investments. And I don't want to get ahead of the 301 review on tariffs, but this is a commitment that President Biden has made, and I agree with it. I was in China just a couple of weeks ago and made clear that we would not allow Chinese overcapacity to harm our emerging industries.
Does the U.S. want a trade war, though, with China?
We believe that we should have a deep and productive, and that we do in most areas, trade and investment relationship. We're working to stabilize our economic relationship. We do not wish to disengage from China economically, but we do think that the playing field should be fair. And China engages in unfair practices like massive subsidies of industries they've decided are critical. And those are cases where we will act to protect ourselves.
We've seen Beijing in the past, though, respond, and it's become tit for tat. Are you expecting a response? Could they go after Tesla or maybe American farm products?
Well, President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
That was the U.S. Treasury Secretary, Janet Yellen. And Manis, that's of course interesting, this idea of retaliation, because Biden obviously wants to do this to win points about being a bigger China hawk. But the threat is, does it cause more inflation? And how China retaliates could go a long way to solving that.
Look, a lot of the products that are involved here were products that America had trouble getting their hands on during the pandemic. And if you think about what it is that they're hiking, it's about protecting technology and knowledge, and it's about knowledge and about sending a signal to the Chinese. But it's interesting, the additional things, they raise on pork cranes and medical products, increases on steel and aluminium. So it's part of its theater.
For the unions. I mean, a lot of those you look at and say, this is what unions have been asking for, and Biden wants that vote. Okay, Manis, we can't forget either that it's also the middle of the Qatar Economic Forum. It is underway in Doha right now. You're again looking at images of Jomana Bersetchi speaking to various finance ministers of both Qatar and Saudi and the chairman of the Islamic Development Bank Group. That is on Live Go, and we'll have more coverage of the conference coming up.
I think the social peace and the focus on the domestic concerns and the domestic development, taking such a great role in the policies of these governments, is really sending the right signals and augurs very well.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg Brief, Danny Berger and Manus Cranny in New York. Now let's head back over to the Qatar Economic Forum in Doha, because over there you can see Bloomberg's Francine Lacqua is moderating a panel with the CEOs of the Qatar Investment Authority, Brookfield Asset Management, Franklin Templeton, and the founder of Hill House. Let's listen in.
Main themes or trend. One of them, again, digitalization and AI. And as you know, all economies is going into digitalization, and widely accepted that this is a mega trend that will impact all economies. Two, climate change, which has been, a trendy investment type and theme for all of the investment. Also, I think the growing of the middle class people during the last cycle, a lot of wealth has been accumulated. And this is, I think, a big theme that would impact maybe tourism and consumers. Fourth is the health awareness, especially after the pandemic. There is two aspects of it. I mean, people are looking after their health, and government after the pandemic has, found themselves that they have not invested in healthcare. So this is. And lastly is the geopolitical aspect and the supply, chain changes. All these themes, I think it will continue for a while. And I think economies will be spending and policymakers will be, focusing on these themes.
Thank you so much. Bruce, what do you see as these mega trends?
Look, I think I'd agree with His Excellency's comments. I'd just say that the trends of decarbonization, deglobalization, digitalization have all probably increased almost exponentially over the last while, especially with the contribution of AI. Look, cloud computing was taking very significant amounts of renewables and data centers capacity 12 months ago, 18 months ago, but it's now taking enormous amounts of capacity. But maybe even the other shift that's happened is that we were in a world 18 months ago where the banks had seized up because interest rates were going up and a lot of money was lost on treasury bonds in the banks. That has abated and capital markets are coming back. So globally, you can now see the markets lifting, transaction activity coming back, And that's a lot different than it was 18 months ago.
Jenny Johnson?
Yeah, so Bruce always talks about his 3 Ds. You mentioned them. I added the 2 other, which were demographics and disinflation. But I think that's been the big change, which, you know, starting in 24, it was, is it going to be 6 cuts from the Fed? Is it going to be 2 cuts? Is it, you know, is it going to be a soft landing? Is it going to be a crash landing? And now there are actually people who talk about whether there would be a Fed increase. And I don't think that's the case because I think Powell kind of came out and tried to quiet that. But there's a whole different view, I think, on how long, you know, how difficult it is to tame the inflation. And whether we get 1 cut or 0 cuts or, you know, some number. I don't think anybody was thinking that last year.
Jean-Louis?
Yeah, sure. I would say the biggest change has been the last 12 months. We have seen traditional corporations adopting technology in a massive way. ChatGPT is as much as a great product in terms of technology, but also as a sort of education campaign or corporate enlightenment, if you will, that actually push every single corporation, traditional businesses that we own, have to think about how technology changes their business models. I'm really happy to see that traditional businesses now leveraging technology to make it better instead of just the digital gap that we saw in the mobile internet.
And can I ask all of you, is this a good time actually to invest? I know some of you have things in the pipeline. I know you're a longer term investor. Bruce, you've been very acquisitive. Is it ripe actually for acquisitions and consolidation?
So we're in the business of buying things and selling them. So it's always a good time to be buying and selling. But look, I would say when capital is less available in the world, it means there are greater opportunities to put money to work, and odds favor returns being higher when you do it. Coming up, we've passed the bottom of the cycle for PE businesses and real estate and infrastructure. And as a result of that, money put to work in the next 24 months, it will be an excellent time to invest. So you know, the markets are just opening up today. And what that means is that whatever you're doing now will probably be pretty good investments.
Is infrastructure a crowded space? I mean, you were one of the first ones, and now you're seeing more players actually enter that space.
The infrastructure is among the largest businesses in the world. It's the backbone of what everything runs on, and that is, it's just, the amount of money that's out there for infrastructure is large, but the need is far, far, far larger. The amounts of money are, I'll say, hundreds of trillions for the things that need to get built over the next 25 years, and there almost isn't enough money to do it. So it's definitely not a crowded space because the needs are so large.
I think it is not crowded. I agree with Bruce. Infrastructure is becoming very important for 2 reasons. Government trying to get the private sectors involved, whether for more efficiency or for selling and paying some of their debt. So we're seeing that most of the government having their agenda to really sell some of their assets and get the private sector involved in their infrastructure project.
Private credit is also the hot new topic. Questions about valuations, actually, over the last couple of days because of rising interest rates so fast. Can you give us a little bit of a perspective on what private credit in Asia is looking like?
Yeah, I think it's really exciting for private credit in Asia because by and large, the traditional corporates in Asia, they have much lower leverage than their US and Western sort of counterparts, and they actually much more into what I call the real economy. So the businesses, traditional businesses, from department store operator to a manufacturer. So that if you have a good research and sector knowledge, if you can structure it well, I think it's a really amazing opportunity to invest in private credit in Asia.
Do you have anything in the pipeline right now? Is there a very clear pipeline?
Yeah, absolutely. We have probably, I would say, private credit has been we have been most active one of in this asset class in the last few months, and we continue to see strong pipeline across multiple areas, from healthcare to consumer goods to manufacturing, to business services as well.
Jenny?
Yeah, no, I agree. And I think there's a lot of discussion about, is there too much money in private credit and, it's not regulated, and is that a concern? And, I think the reality is it's just shifted. The credit has just shifted from banks' balance sheets, particularly in the U.S., into the private credit market. In a lot of ways, that can be a better structure because people invest in locked up capital and vehicles, and you don't have the potential, if you have defaults, you don't have the domino effect of a bank being a counterparty, and arguably in the U.S. also having the government who guarantees a portion of it. So, I just read something like in the small and mid-size direct loan market, it has dropped from 70% of banks to 11% of banks, and the rest is being filled by private credit. So I think it's a great place to be. And honestly, if you look at for the illiquidity premium, if you could withstand it, you're talking cash at 5%, high yield 7.5%, 8%. High yield is almost priced for perfection in the public markets, and then private credit closer to 12%. That's a pretty good return.
Longer term, Your Excellency, when you look at some of the big challenges, how do you deal with AI right now? We're talking about investing in the next generation. So you're taking decisions now for something which is still quite difficult to read.
We have, I think we have to admit the fact that AI is still a new technologies. When you draw the spectrum of the AI, you see some of the aspects are very clear. It has a business model, like, for example, the data center, the chips, and so on. And then when we go into the quantum computing, and then the data organization with our labeling, categorization, and then into the software and application, all these are, we are investing in a smaller basis in all of these, but still, if you ask me, what is the big winner of this? I don't know. And, when you remember in the internet, during, in the 90s, when the search engines came to the surface, a lot of the names are not existing right now. I remember Alta Vista and so on. So I think there will be a lot of changes. It is not clear where is the big win in AI. But the good aspect of the AI technology is that all of the stakeholders are in agreement to invest more into the space. So you have investors like us, you have the policymakers are keen to attract businesses and investment into this space. And you have also companies who have the know-how, like Microsoft and in technologies, things is moving very fast, and it is accelerating. So it's still not 100% clear what is the big one.
Can I ask you about your strategy of it? How do you find the perfect time to deploy actually cash?
We are deploying, we are investing, we are continuing investing in the space. But then we make sure that we have a very diversified portfolio into the space. Yeah. So we are in full speed in terms of investing in data center. We are in full speed in investing in data, categorization. We are in full speed in investing in software and application that have a feature of the AI. Yeah. And we are a big player in the chip maker companies. So we are investing and we are not stopping. But I'm saying that still
early.
Yeah, the big win still is not very clear for most of the investors.
Brookfield did this mega deal. Can I call it mega deal with Microsoft? I mean, it's a big deal. Is this a template of future deals of how you structure them?
Yeah, so the deal we did with Microsoft is a framework deal where we're going to build them 10,500 megawatts, 10 gigawatts of power over the next 5 years. And that will essentially be a framework for other things we do with them in the future. And that's about an investment of about $10 or $12 billion. And what's really important to understand today, because everyone thinks about renewables and is it in a bubble, but the important thing to know is that in most countries of the world, the cheapest cost of bulk electricity is solar or wind. And that's dramatically changed from 10 years ago. the cost curves have come down, manufacturing costs have come down, and as a result of that, there's going to be, over the next 20 years, a very, very significant build-out of renewables in the tens of trillions, and that will decarbonize the world. And the technology companies are leading the way because they've all committed to net zero, Microsoft being one of the leading ones, and this is a part of it. But I think it will be the biggest thing today for them to find is credible parties with projects that can build them out and meet their supply. And so we're continuing to do that around the world with great companies like them.
And Jane Johnson, where are you finding the deals? So how do you want to grow Franklin Templeton?
Well, first of all, you asked the question earlier about is it a good time to invest in the market and what is His Excellency doing with his cash? And John Templeton said the best time to be in the market is when you have money. So, and it's because you can find opportunities, anything. So whether it's AI, and I agree with you, I mean, I think the initial AI types of things are picks and shovels, right? It's the chip makers, it's the Microsofts, who are running cloud computing. But the next phase is going to be as companies, and they'll start to differentiate within their own businesses, those who are actually using it to a competitive advantage. And it's hard to see that today, and it takes a while to do that. But I think based on the trends, it's always easier to swim with the current, right? So if your trends, and we talked about the Ds of deglobalization, so it's figuring out who are going to be the beneficiaries of that. In this region, I mean, one of the things that I think is so impressive, obviously, as oil stays high, and it doesn't look like there's any quick resolution to Russia and Ukraine, so it's likely to stay high. There's a mentality of multiple generations, which is something I very much appreciate, and a desire to diversify an economy. And so the various economies, and so you find investment opportunities as there's diversification. And so making sure that you're close and part of those conversations is where you find investment opportunities.
Absolutely. If I could add what Jenny said, the settings for investment. Right now, we are, in a very dynamic environment. You could say, whether you worry about interest rates, whether economic uncertainties or geopolitics, seems a lot going on. But we have observed that actually the best companies are built in the time of uncertainties. And the best businesses are actually gaining tremendous market share in economic uncertainties. So we've seen, give you some examples. I talked about traditional companies leveraging technology. One of our portfolio company is one of the largest lady footwear retailer. That they are adopting technology to make the supply chain much more robust, much more nimble, and faster replacement cycles. And they are adopting technology to train their employees so that every employee have a kind of small app that they can train them just flipping page like TikTok, so that every training is breaking down. So that I've seen that companies take advantage of this kind of economic uncertainty, invest in technology, leverage technology to do it better. We had another company, it's traditional business, a mattress company, one of the premium mattress company that in China that had difficulties, during the real estate bubble burst and during the, the quarantine of COVID lockdown, that they would have the amazing slogan in the TikTok, basically saying that if you ever got, quarantine with our mattress. So that's really doing very well. They're leveraging technology, access customers, access supply chain in a faster, efficient way.
John, what's your investment strategy looking like? So is it still, what's your take on China and fragmentation?
Right.
Right. Is this temporary, or are you looking to tilt towards a more pan-Asia investment strategy?
Well, Hillhouse had always been a pan-Asia investor, but what we're seeing in China, that's interesting opportunities actually coming from the winning the losers game. You're seeing companies not long-term enough, not consistent, have really steady hands, actually losing shares. I think what you do is very basic. You just have a long-term mentality, be very consistent, invest in traditional businesses that can leverage technology to be better. I think that's enormous. I'm seeing same thing happening in other parts of Asia that do the same thing. That people are investing for the long term, have the steady hands. It's almost like this tennis, right? That you're sort of not necessarily the most powerful players win. It's that just avoid sort of unforced errors, have steady hands. Over long run, you're gonna have a better chance.
Well, Lee and I were talking earlier about China and the opportunities of investing there, and you always get asked the question as an American business, how do you feel about China? What are you going to do? And the answer is it's the second largest economy in the world, and often when people out figuring out those trends again, and within China where there's a desire to build a domestic market. And again, a lot of the competition has gone away, that you do find opportunities. It's sort of gone through a lot of its pain with the real estate resetting and other things, and figuring out where those are, I think is good.
I would just say, Francine, that there are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact, a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing...
Great conversation there with our very own Francine Lacroix, speaking to the CEOs of Qatar Investment Authority, Brookfield Asset Management, and Franklin Templeton, as well as the founder of Hill House. We'll bring you more conversations with global leaders throughout the day from Qatar. And if you've got your Bloomberg, of course, you can catch up on Live Go on your terminal. Leave you with an image of Bruce Flatt. More to come from Qatar. And of course, surveillance is right up ahead. We'll see you tomorrow on Bloomberg.
Different.
Yeah, the prices in China is becoming very...
Economic surprises have really plunged over the last couple of weeks and are now in negative territory.
The momentum in inflation in the last 3-4 months has just been moving in the wrong direction.
Welcome back. This is a Bloomberg Surveillance on Bloomberg Television. Anne-Marie Herdern and Lisa Abramowitz. John Farrell, we'll be back tomorrow saying good morning. Good morning. I promise he is off today. However, today we are so lucky to have Brian Levitt of Invesco with us for the hour, our favorite FOMO kind of guy, who's been absolutely right at a time when everyone's been looking for signs of greater disinflation, starting with data about 2.5 hours from now. Good morning. We are looking at markets that are doing pretty much nothing. They did pretty much nothing yesterday as well. Brian, are you still a FOMO kind of guy?
I am still a FOMO kind of guy. And, the reality is we're in this environment right now where everybody's talking about the Fed. They're so concerned when the Fed's going to move and by how much. The reality, Lisa, is markets historically have done very well with the Fed on hold and the economy reasonably strong. So we're still in a good nominal growth backdrop. I know everyone's going to be staring at that tense place on every inflation point that comes out. I still think we're in an environment where inflation's going to moderate and ultimately these markets are likely to press higher.
At a time when we are at the twilight of the earnings season and people are very much looking to tomorrow when we do get retail sales to get a sense of the latest read, we are getting Home Depot earnings coming out. A bit disappointing with comparable sales down 2.8% versus an estimate of 2.2%. We'll parse into all the details. So far, has the read-through been generally, Brian, that we do see a weakening consumer, but still strong enough to power optimism and FOMO types of feelings?
Yeah, we do see a little bit of a weakening consumer. You've seen that a little bit in the latest consumer sentiment number as well. But we have to remember that's what the Fed was trying to accomplish. We can't have it both ways. So we had this robust consumer that had everybody concerned. The Federal Reserve has raised interest rates. Things are moderating. We can't now look at the other side and say, oh, the consumer's falling off a cliff. I mean, we knew the consumer wasn't going to continue to spend at the same clip, but the reality is we've got a very low unemployment rate. Leading indicators for the job market continue to look fine. And so that's supportive for the consumer. It's not the same excess savings that we had a couple of years ago. The government's not coming back with $6 trillion, but it's a consumer that has a job and continues to feel good about their situation.
We're talking about a couple different prongs to the hour. We're going to be talking about inflation data coming out at 8:30 a.m. today and then 8:30 a.m. tomorrow. We're going to be talking about earnings as they come out. And of course, we have to talk about the policy backdrop. And Anne-Marie, we did see, as expected earlier this morning, the Biden administration came out and did announce those tariffs on certain Chinese goods, targeted tariffs. Did we learn anything new from the actual announcement this morning?
Well, we have the top line number now. So the changes in the impact of these new tariffs, and it's across a wide scope of imports, semiconductors, batteries, solar cells, critical minerals, $18 billion in current imports. I think what's interesting about this, one, the administration's been talking about this literally for years when they took the review of the Trump-era tariffs on board with the 301, but also they've signposted this, and this really has to come now at a time where we're less than 6 months out from the election, and both Biden and the former president are jockeying for votes and talking tough on China. That remains very key and top of mind to American voters.
So we're going to be discussing this throughout the hour in terms of how you really plan around this and invest around things that some people say could be inflationary, could dampen growth. Right now, just to get a state of play of what's going on in markets, basically flat yesterday, pretty much on par for the same today, hovering around that 52.47 mark. You could see yields just around, again, 4.47 on the 10-year, on the 2-year. You can see a similar type of stasis. Crude slightly down, but this is a market that really is on hold as we wait for some sort of sign of a catalyst of whether we're heading toward that immaculate disinflation, or maybe not immaculate, but at least a soft landing versus stagflation. Brian Levitt, who is with us for the hour, I want to ask you about the latest Bank of America fund manager survey, which came out and showed investor optimism at some of the strongest levels that we've seen going back to 2021, even as investors are expecting a deterioration in earnings and a deterioration in the economic growth trajectory. Is this entirely dependent on the Fed cutting?
Well, it's not entirely dependent on the Fed cutting. You know, as I had already said, if you look at years like 06, you look at years like 2019, or even now, market can do very well with the Fed on hold. So the good nominal growth environment has been supportive. I do suspect, like the Bank of America survey says, that things will slow. You think about slowdown, we'll see if the Fed feels comfortable cutting within that. I think they would like to. But I think what investors are looking to is over the next few years, we're going to be normalizing the yield curve. And if you can normalize the yield curve without having had a meaningful disruption in economic activity, that should be a positive. I've said over and over that peak inflation, peak tightening, peak interest rates over the next few years should be good for equities. And I continue to stand by that.
Which is the reason why in this fund manager survey, Anne-Marie, we did see this optimism of several rate cuts this year, even with a deterioration in backdrop because of this promise of potentially peak yields. Michael Hartnett over at Bank of America did raise the specter of stagflation, which is something that Jay Powell has shrugged off, laughed off. There is no stag, there is no inflation. This is the biggest headwind right now that a lot of people say to equities.
A lot of people are saying this to equities. David Malpass, former head of the World Bank, this is his whole thesis into what we're actually seeing in some of the data he's looking at. But I look to the Global Fund Manager Survey sentiment not as close eyes and sell levels, but risk assets are vulnerable to more evidence of stagflation. Brian, do you see any evidence of stagflation?
Well, I like the way Lisa put it. And I was going to say, I don't see stag and I don't see inflation.
Well, that's Jay Powell.
Exactly.
So let's start with inflation. If you look in the bond market, whether it's the 3-year break even, the 5-year break even, the bond market's expectation for inflation, they're all very stable, very much within the Fed's comfort zone. Now, with regards to stag, it's certainly not a stag economy. Are things going to slow? Well, yeah, that's ultimately what we wanted to have happen. As things slow, inflationary pressures should moderate. You're already starting to see it. You know, when everybody talks about the momentum of inflation over the last few months, it hasn't been too much on the consumer side. Very critically, it hasn't been wages. Wages have been generally benign. It's been a lot of import inflation. And what are you starting to see already with commodity prices? What are you starting to see with oil? Kind of moving down. And so I think that what ends up happening when we get to these pivot points, and Lisa, you started the show with that pivot point, people, for whatever reason, think of the worst environment that they can imagine,
Catastrophic thinking?
Yeah, it's
They're
like
watching Lisa.
It's genetic, carry on.
Well, she just said pivot. She didn't say catastrophic. All of a sudden, it's going to be the 1970s again. And yet this is a very different environment. If you look at the misery index, which is the unemployment rate plus inflation, it's historically quite low. Right, that doesn't suggest stagflation. Now, could it move? Yeah, but what direction is inflation going? I don't think it's heading higher here.
Part of the problem that a lot of people are looking at, including Philip Jefferson yesterday of the Fed when he was speaking, is we just have seen this persistency to inflation. And what we've seen is an actual acceleration, a re-acceleration in the first quarter inflation data versus the last quarter of last year. This could be year-over-year comps, but you take a look yesterday of the New York Fed Consumer Sentiment Survey and inflation expectations, and you could see they are creeping higher. And it's not just broad-based, but also for home prices, which were supposed to be the most affected by keeping rates where they are. So at a certain point, you have to look at that and say, hold on a second. We can dismiss this as going to be disinflation, but we expected that pivot point last year. We expected that pivot point 6 months ago. If you ignore what the data is actually showing, that will be another error.
Correct, although the question is, when we see things ticking up a little, they're off of low levels. Some of it's being driven, or relatively low levels, some of it's being driven by commodities, and some of it's likely being driven, if you look in the Consumer Price Index report, by some of the lagged effects of shelter. Housing and rents had come down over a year ago, particularly rents. I mean, I don't know which one we want to look at, but if we believe the Zillow numbers or others, those rent numbers should be down by now, so it's not being captured necessarily in the Consumer Price Index. Fed's preferred measure of inflation below 3%. That's the core personal consumption expenditure. As I mentioned earlier, the tips break evens, relatively benign. So I think I wonder if the consumer, when they're being asked, are they thinking about the high cost of living, which is now part of our life, or are they thinking about the change and the rate of change? It's kind of like everything I learned I needed to know in kindergarten, everything I learned I needed to learn in calculus class. So ultimately, this is going to, in my opinion, it's going to moderate. We'll look back and say, remember, we were worried that the economy was too strong, the consumer was too strong, it was all inflationary. Then we'll be in a slowdown, and the market will, do a 10% decline in a slowdown, and we'll be saying, gee, I really miss those strong nominal growth days.
The thing is, though, and when Lisa brings up the New York Fed one-year inflation expectations, the survey, the bank said that respondents project inflation a year from now at 3.3%. That's much higher than where we are today. How much does that inflationary concern on top of consumers' minds change how they're potentially going to go out and spend the remainder of the year?
Well, you're starting to see, I mean, if you look at the Michigan survey, the consumer is starting to say that these prices are becoming, somewhat problematic. And so remember, the recent move, we've had a move in oil prices, we've had a move in gasoline prices. Those are starting to moderate, at least on the oil side, starting to moderate here. And so remember, we started this by saying, can the consumer hang in? Right, and the consumer's saying things are likely to slow here a bit. You saw it in the Home Depot numbers, and so we shouldn't be, we shouldn't be. Well, on this side, the sentiment says inflation's going to keep going, but the numbers are showing that they're moderating. Again, from our perspective, if we look at the consumer momentum, pretty benign, wages pretty benign. A lot of it has been this import price inflation that now seems to be moderating.
You mentioned Home Depot. Let's just give you a rerun of that. If you are just joining us, they did report earnings. Comparable sales coming in light, down 2.8% versus the estimate of 2.2%. You could see customer transactions were down about expected, about 1%. The key here and why you're not seeing a bigger move really is that they still keep all of their 2025 year forecasts. The comparable sales about still down 1%. Sales still increasing by about 1%. Earnings per share share growth about 1%. So this really does seem to point to stability, as we heard from Brian. Here is also this idea that, yes, there is a softness due to people maybe not moving, have already done a lot of the home improvement, but there is this sense that people still have money to spend. If there is one takeaway, Brian, from this earnings season, what would you say it is?
It's a mixed picture, but I would say the biggest takeaway is that everybody thought we'd be in a recession by 2023, and we're still growing earnings 10% in the quarter. And so it's still a good nominal growth backdrop. And everybody's worried whether inflation's 2.8, 3%, 3.3. Remember, businesses make money in nominal terms, and so a good nominal growth environment is supportive for corporate profitability. And what I say to investors, if they were so worried we'd be in a deep economic downturn by now, the reality is things still are good and companies are still benefiting. It's mixed, right? We're seeing more from tech, we're seeing more from financials than perhaps energy or some other parts of the market, but again, another good earnings period.
All of this being said, next we're going to talk about the policy implications and how that factors into all of this. Brian Levitt, you're going to be staying with us for the hour. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with our own Danny Berger. Danny.
Hey, Lisa, French President Emmanuel Macron says he would be open to a takeover of a major French bank, even by a non-French bank, as long as they're in the EU. Macron said deeper financial integration is critical for the bloc's future prosperity.
Dealing as Europeans means that you need consolidation as Europeans.
So it could be cross-border mergers in both directions.
This is a totally new world, and we do need this new business model for the Europeans. More innovation, more investment, single market and capital market union, and a relevant trade policy.
Macron there was speaking exclusively to Bloomberg at the annual Choose France summit. There he said that the EU needs a fresh approach to business. Let's just recap some of the breaking news on tariffs we got about an hour ago. President Biden imposing new tariffs. We've been waiting for this on Chinese chips, minerals, and EVs. It's an election year bid to boost domestic manufacturing. The White House says the move will affect about $18 billion in imports. It is the most comprehensive update to tariffs on China, which were first imposed by former President Donald Trump. The changes will take effect between 2024 and 26. Chevron's bid to buy Hess has hit a snag. Investors are being urged to abstain for voting for the deal. It comes as a shareholder advisor cited concerns about valuation and a dispute involving Exxon over an oil project in Guyana. It's yet another blow to what would be Chevron's biggest deal in 2 decades. The transaction still needs a green light from the FTC, and it's expected to drag on for at least until the end of this year. That's your Bloomberg Brief. Lisa.
Thank you so much, Danny. Up next, Goldman Sachs' David Solomon saying the U.S. needs a sharper focus on debt.
We're long out of that pandemic, and the spending levels, are continuing at a pace that I think is raising our debt level and creating issues for us down the road. So I think this is something that deserves a lot of attention. It's not getting as much attention as I'd like to see it get right now.
Oi, the deficit. That's next. This is Surveillance.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back on a day where everyone is looking to 8:30 a.m. for the beginning of a key inflation data dump that we get throughout the week. Right now, we're seeing basically absolute stasis in markets, because why would anyone have a conviction trade at a time where it seems like people are on tenterhooks waiting for the next narrative pivot? We are seeing a bit of action, though, with yields lower once again, 447 on the 10-year. Under surveillance this morning, Goldman Sachs' David Sullivan saying the U.S. needs a sharper focus on debt. Here's the latest. The U.S. facing a debt crisis, at least some say so, with the budget deficit more than 6% of GDP last year and unemployment below 4%.
The level of debt in the United States, the level of spending is something that we need a sharper focus on and more dialogue around than what we've seen. We obviously had a pandemic. We made a bunch of decisions, in that pandemic, but we're long out of that pandemic, and the spending levels, are continuing at a pace that I think is raising our debt level and creating issues for us down the road. So I think this is something that deserves a lot of attention. It's not getting as much attention as I'd like to see it get right now. We're obviously in an election year, so I'm not, I don't have my head in the sand. I don't think you're going to see that get a lot of attention prior to the election, but I do think it's something that requires focus. We need to deal with the debt and the deficits, and, hopefully there'll be a lot more discussion as we come through the election and move into the next administration.
Well, let's give it a bit of time now if we can. I often say that the United States has a privilege of behaving recklessly sometimes that maybe the likes of the Europeans do not. Have you sensed there's been any kind of pushback from the Treasury market, from investors, against the backdrop and this risk that we're talking about currently?
Well, the reserve currency is a great privilege. And, I'm not going to sit here and say that I see in the near term, a threat to that in any way, shape, or form. But it's not something that you can take for granted. And the United States' ability to spend without constraint is not unlimited. Ultimately, the market will challenge that. Hasn't challenged it yet. I'm not saying that's something that's coming soon, but it's certainly something that we should be very cognizant of and very protective of.
Do you think the experience of the UK a couple of years back was maybe a case study for what we could face in America?
Well, that was a disruption to the gilt market, and it's one of the things I think you need to be concerned about. It's a risk issue I've highlighted before. At the time, the Bank of England had to reverse its course and become very accommodative to deal with that blip in the markets. We've had disruptions of the Treasury market before. We certainly had a disruption in March 2020. To the degree that we had a significant disruption in the Treasury market sometime in the future, we don't have a lot of capacity through the banking system to intermediate that. It would require very accommodative policy. If that came at a time where that was not right for the central bank to be accommodative, that would be a risk issue that would have to be monitored. We're definitely not falling off a cliff. I think the U.S. economy is chugging along pretty well. I think the market is set up for pretty much what you see now is what you'll get throughout the rest of 2024. There have been a bunch of data points that indicate a slowing in what I'd call the bottom 25 or 30% of the consumer economy, where people are making different choices and starting to tighten up on some of their spending choices. You've seen some earnings reports in the last few weeks that indicate that. But broadly speaking, the service sector is still relatively strong, and I think the economy is still in pretty good shape. Where it'll be in 6 months, how much of that slowdown we see in the bottom quartile, we have to watch the data very, very carefully.
That was David Solomon of Goldman Sachs sitting down with our own Jonathan Ferro in Versailles. Watch the whole interview on YouTube, on Bloomberg.com if you missed it. Brian Levitt still with us of Invesco. And, we're hearing a lot about the deficit. And before we get to some of the other policy prescriptions, are you in the oi the deficit camp, as Steve Eisman said?
I am not in the oi the deficit or the oi the debt camp. And it's interesting, Lisa, it's the #1 question that I get from individual investors. It's as if people believe they're going to wake up one morning and there's going to be a debt crisis in this country that resembles an Argentina or a Turkey. This is not how this is going to move. And here are the things that I like to talk to investors about. The first thing is, we did spend a lot of money in order to respond to two crises, and we got out of those two crises without disaster or depression, right? So let's be happy we live in a country that can do that. The second is, the U.S. is a very wealthy country, so people throw around the 35 trillion number, which is large. I've read that you can stack dollar bills from here to the planet Uranus, and you're not at 35 trillion. It's a large number. But what's the total household net worth in this country? It's $150 trillion. Right? So household net worth in this country is 5x the debt level. Very wealthy country. And the third point is, we have a very captive audience for U.S. debt. There's not going to be a moment of comeuppance where the federal government isn't going to be investing in it. The U.S. financial institutions aren't going to be investing in it. My father, who loves 4.5%, isn't going to be investing in it, right? And even the foreign investors, remember, China's only 2%. Japan, the Brits, Germans, those are all ally countries.
If you're worried about the deficit, no, Mr. Levitt's on the other side of you, and he's got your back. I am curious, Brian, just on a broader level, we have been hearing about all of the tariffs that might come down the pike. They did come down the pike today. Emery was mentioning that. How much do you take this into account, not necessarily with electric vehicles, but more broadly in terms of areas that you won't invest in, or notes of caution around international companies that might face headwinds in places like China?
Well, my view is that tariffs will lead to less optimal economic outcomes, right? We've all learned in our courses about comparative advantages, and you want production taking place where countries or regions have the comparative advantage. So if you don't do that, there's less optimal outcomes. But from the market perspective, the market will price it in fairly quickly, right? So the markets will adjust on a valuation basis to take into account the tariffs. What the market needs is clarity. And so if you think about 2018 was a 20% down year in the markets. The Fed was raising rates, but I would argue it was largely because of the uncertainty of the trade war that hit business investment. And once we got clarity, regardless of what the terms of it was, by 2019, we had a much better year for markets. So again, less optimal outcomes, market will price for it quickly. Clarity, in my opinion, is what's most important.
Treasury Secretary Janet Yellen said yesterday to me when I sat down with her in Virginia that potentially China would respond to this. This morning, the Treasury's out with a statement, and she ends with it saying that she looks forward to continuing to advance U.S. interests on behalf of the administration's behalf, to have a responsible management of this economic relationship. But seeing these kind of tariffs and the walls going up, depending on who's in the White House, it's going to get more fractious when it comes to the U.S. and Beijing. How does an investor you deal with that?
Yeah, and that's probably the one thing that our policymakers agree on, right? From both of our candidates agree that we want to be more America first or tougher on China. You know, the point I was making, Elisa, is that the markets do tend to respond to it pretty quickly. So it creates value opportunities for investors. Now, if you're a U.S. investor considering Chinese assets, what you recognize is that valuations have been cheaper for a while. This supports that. What you're looking for in China is things were weak. Are they improving? Are we getting surprises to the upside? And is policy going to be supportive? And I think both of those answers are yes.
Especially with the latest bond sale. Brian Levitt, you're going to be sticking with us. Coming up, we'll go live to the Qatar Economic Forum for a conversation with Jenny Johnson of Franklin Templeton.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera. And I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Welcome back. This is Bloomberg Surveillance on the key inflation day and the data dump that we're going to get this week, starting with PPI in about 2 hours' time. Markets more about not doing much, although still up about 5% on the S&P, going back to the third week of April as we look to a potential Fed that is going to be cutting rates. If you look at what's going on in the bond market, you could see the yields just basically hovering around that same level. You can see 483 on the 2-year, 447 on the 10-year. For exchange, somnolent as well, as people try to get a sense of whether this is going to be the exceptional U.S. or whether we're basically moving toward a different kind of environment. Before we get to other stories, wanted just to have a quick beat. Brian Levitt with us of Invesco. How much are you watching the whole GameStop craze in terms of GameStop and AMC and the return of Roaring Kitty?
The return of Roaring Kitty. Well, that's certainly interesting, but what I worry about it is that it gives investors the perception that all of this is manipulated or none of it is real. And the reality is when you look at the broad market, corporate earnings have been moving up as well with the market. So there's nothing fake about what's going on in the broad market. I do worry that the meme stocks give some people the wrong impression. Look, I think maybe we'll get a dumb money sequel to the movie, something I can watch on my next flight. But it's entertaining, but I don't put a lot of emphasis on it.
That's the reason why a lot of people are dismissing it and saying that it's not necessarily going to be similar to what we saw back in 2021. Under surveillance this morning, Secretary of State Antony Blinken is in Ukraine, looking to assure leadership of the country's defense against Russia. The visit and meeting with Ukraine's president comes as U.S. aid was held up in Congress for months. Weapons and aid from the $60 billion approved by Congress in April are now making their way to the battlefield at a time, Anne-Marie, where you're seeing some rejiggering of leadership, particularly in the defense sector in Russia. What is the latest in terms of progress in this conflict?
Well, this is an urgent time for Ukraine. You see the Russians are coming in and making a massive offensive into Kharkiv, which probably the biggest we've seen since this war began. It also comes at a time that Zelensky is once again saying we need that support from the United States. Remember, the money that they just signed up for is delayed. They were talking about this kind of money to support the U.S. industrial base, to send more of those weapons to Ukraine in the fall of last year. We are now in the summer. So Zelensky this morning saying Ukraine needs 2 air defense batteries just for Kharkiv. Also interesting, Blinken touching down in Kyiv. This morning we find out in a few days' time, Putin will be going over to China. It is so important how China has been really helping Russia in terms of being able to continue to sell their oil and gas and some of the other ways they are really putting their thumb on the scale and helping Putin conduct this war.
Which brings us to our next story, which is President Biden announcing sweeping tariffs on Chinese chips, minerals, and electric vehicles. The White House saying the move will affect about $18 billion in imports. This marks the most comprehensive update to tariffs on China, which were first imposed by former President Donald Trump. None of those were rolled back, as some people had initially expected. Just to connect the two stories, it seems like the rivalries between the U.S. and China keep amping up. This is widely expected. Is there anything new in this? You talk about the headline number, but new in this that gives an indication of what Biden's trajectory will be going forward with respect to this relationship?
Well, the trajectory looks like they're prepared for a little bit more of that tit for tat when it comes to Beijing. Recently, what we saw, one response Beijing had was on a chemical import that the U.S. has an export into China. They put a tariff on it. China potentially can respond to this. That is something the Treasury Secretary alluded to me yesterday. But I think what this shows is that whether or not it's Biden or Trump next year, the walls are going up when it comes to China. And at the same time, if you're the U.S. administration, you're trying to get Beijing to potentially lessen that thumb on the scale when it comes to helping Putin. They're not in a position that they're going to want to do that at this moment if they see actually there's going to be more of this disengagement with the United States.
Meanwhile, on the economic front, the consumer in focus and inflation data and retail sales coming out this week. Jonathan Farrow yesterday sat down with Bank of America CEO Brian Moynihan, who is optimistic on the state of the consumer despite higher rates for shoppers and borrowers. Take a listen.
But I think our team thinks that the terminal rate, the end rate that they'll get to will be more in the 3.5% range as opposed to 50 basis point range or 1% range. And we haven't really had that since before the financial crisis. There was a moment in 16, 17, 18 where they raised rates and they already started bringing them down to 19. So frankly, in our team, I say, if you're under 40, you've never seen this kind of rate environment. And this is normal. And so 3% front end, 3.5%, 4.5% 10-year. And people will get used to it because America did a lot of economic activity prior to 2007 for the 200 plus years of existence. So people have been used to it. It's just that we're in a very unusual time. And so the adjustments are taking place and it's running through the economy.
We're hearing from some companies that maybe there are some cracks. We heard from Starbucks, McDonald's offering a similar view on the U.S. consumer. You've got some 69 million customers. What do you see? Do you see those cracks at all starting to emerge this year?
So if you think about it, where would the cracks emerge? You talked about the average account balances. They're still, especially for households 75, 100,000 and below, the account balances are higher than the pandemic by a lot. If you think about the spending settled into a more normal, where it was in 16, 17, 18, the Fed was raising rates, inflation, they're pushing, inflation was higher, they're pushing it down or holding it steady. So that's normal. And then on the credit side, we're just normalizing to where we were in 19. So in 2019 was a 50-year low in credit costs in our company, and basically last quarter we were a little bit higher than that. And so we're normalizing, so it's increasing off a base. And people say, oh, your charge-offs are going up, but they're getting back to where they were in 19, and frankly, people thought that was very good credit, and it factually was. And so the question is where they go next. The good news is we're starting to see delinquencies flatten back out, i.e. they're not growing anymore. They normalize, and then they're staying. That's good news on the consumer side, so it's all okay.
That was Brian Moynihan speaking to our own Jonathan Farrow. Of course, the FICO scores on average of a Bank of America client are higher. So there is this question of how bifurcated this is. A host of financial and economic thinkers are meeting right now in Doha for the annual Qatar Economic Forum. Bloomberg's Haslinda Amin is sitting down with Franklin Templeton CEO Jenny Johnson. Let's head over to Haslinda. Haslinda, thank you for joining us. Please take it away.
Well, that's right. Of course, it is an area, a region which Jenny is really interested in. Jenny, lots of money is sloshing around in this part of the world, especially with the sovereign wealth funds. But there's also a lot of competition. How do you nail those deals eventually, ultimately, you think?
Well, actually, Franklin Templeton's been in this region for over 25 years, so we know it well. We acquired in 2007 a local asset management company, so now we're one of the biggest GCC bond managers. We're one of the largest multinational Sharia managers. So, we're really steeped in the culture and the business here, and 4 of the top 10 sovereign wealth funds are here. So then it's about what do you have that they're interested in? And with the alternative capabilities that we've built out, fortunately, that's been an area of great interest.
How does the region fit into your longer and bigger strategy as you navigate the company from active to passive?
Well, we're very much focused on active management, so we're fans of active management. Where passive has done well is on the equity side. Fixed income is still pretty active, and obviously the alternatives not. So, again,
we have clients in 160 countries. So our job is to have capabilities that work for any of our clients. And as these sovereign wealth funds, which often think very multi-generational, so they're real long-term investors, we see that our private market capabilities has actually been probably more at the forefront of their interest. But then in the central banks here, they tend to be much more conservative. So the traditional fixed income capabilities and equity capabilities are, areas of interest for the central banks.
The thing is, when you take a look at sovereign wealth funds, for instance, there's growing interest in private credit and alternative assets. Is there a sense that perhaps you might have to do acquisitions in this part of the world to meet the needs and the interest, growing appetite?
Well, fortunately for us, we did do an acquisition in 2007. It's traditional fixed income, but actually we had a client, a sovereign wealth fund, saying they were interested in Sharia private credit. We were able to have our local team reach out to our private credit team and say, why don't we work together and deliver this? We'll do this Sharia screen and you manage the private credit. So, we think of all the different investment capabilities as we have as ingredients, and we can build customized solutions for clients.
Jenny, I also want to talk about China, because not too long ago when we spoke, you talked about how there's been so much pessimism priced into the Chinese market. We're seeing some improvement. How are you assessing the potential there?
Yeah, I think there's been a lot of pain, obviously, in the Chinese market, and you've seen it with where the equity markets went. Again, it's the second largest economy in the world. They've been very focused on growing their domestic economy, and that therefore creates opportunities. We've had a joint venture in China for over 20 years with local investment people on the ground. When you're in a local market, you can understand where there's growth and where there isn't growth, and that creates investment opportunities. And I think the thing that we've seen with China is when the government of China wants to do something, and they have indicated that it's important that they have a robust market, they can provide the kind of incentives and catalysts to do that. So, we think China has gone through a lot of pain, but there's still opportunity in segments of China.
Have you seen the worst in Chinese property market?
So the Chinese property market's interesting. Again, where there's pain, there can be opportunity. I was talking to somebody who says the wealth channel in China, that families who have lost money in the property market are realizing they need to have a diversified portfolio. So they're just starting to diversify out of some of their real estate into other parts. Again, as a manager with investment teams on the ground, that's a great opportunity for us.
Of course, we're all keeping an eye on that U.S. election. If we have a Trump 2.0, Jenny, would it change all the assumptions you're making right now about investing in China? Because we saw how the Trump administration caused a lot of pain. We saw how the yuan slumped during his administration.
What I think that potentially could be underestimated is the entrepreneur's ability to figure out how to navigate these kind of environments. And in speaking to folks in Hong Kong and who handle supply chains and others, there are a lot of mid-sized companies in China who have figured out that they can set up their last stage of manufacturing in Vietnam and Indonesia, Malaysia, and just assemble enough to meet, say, the WTO requirements, and then it's stamped made in Vietnam, for example, and then it gets imported into the U.S. and bypasses those tariffs. So, look, there's no question that there's a shifting of supply chain that's going on that naturally has to happen. But I don't think it kills the Chinese economies. I don't think a Trump administration necessarily is going to do that.
You talk about the shifting of supply chains, and a lot of the countries in this part of the world, in Asia, have benefited as a result. Are you seeing attractive markets right now that were not considered before?
Well, certainly, in Asia, a lot of those smaller markets that I just mentioned are getting the benefit of this China plus one supply chain story. I think, obviously in this region, with the price of oil where it is, and I don't think anybody sees a quick ending to Russia-Ukraine, so chances are oil stays high. There's a real desire to diversify the economies here and make investments in technology, AI, renewable energy. All those they're looking for partners, so all those become an opportunity to make investments.
Jenny, thank you so much for your time.
Thank you.
Jenny Johnson, Franklin Templeton CEO, and Lisa, Handing it back to you. We're coming to you live from the Qatar Economic Forum.
Thank you so much. That's Bloomberg's Haslinda Amin at the Qatar Economic Forum with Franklin Templeton CEO Jenny Johnson. Thank you so much. Great work as always. Right now, let's get to an update and stories elsewhere this morning. Here is your Bloomberg Brief with Danny Berger. Danny.
Thanks, Lisa. Let's get a check on Home Depot shares. Down by about 1/3%. It reported a 6th consecutive quarter of negative sales. Yet another retailer flagging some softness in the consumer. This time it's one that has been holding off on renovations and instead prioritizing essentials. The CEO, Ted Decker, says that Home Depot was hit by continued softness in certain larger discretionary projects and a delayed start to spring. Now, speaking of retailers, the next big box earnings we're going to get is Walmart on Thursday. In the meantime, Bloomberg has learned that Walmart is set to cut hundreds of corporate jobs. It has also asked most of its remote workers to return to the office. Employees, if they're in a smaller U.S. office, are being asked to go to the bigger hubs. That includes their Arkansas headquarters. And the meme stocks, they are roaring back. Traders once again piling into shares like GameStop and AMC. GameStop yesterday surging more than 74%. It's up almost another 50%, 59% in the pre-market trade. All that was needed for this rally was just one tweet from Keith Gill yesterday, also known as Roaring Kitty. The post on X, it had no words. It was literally just a picture of a man sitting up with a gaming controller. Gill hasn't been active online for years, so it was seen by some as a call to action, and a call to action they got. That's your Bloomberg Brief. Lisa.
Thank you so much, Danny. Up next, commodities in focus.
And I've got to admit, over the past couple of weeks, I'm increasingly looking at the commodity market and getting more and more nervous that inflation is actually going to creep up through the commodity market. And that was off my radar, I would say, 2-3 weeks ago.
It depends on where you look in the commodity sector, but certainly in some of the precious metals. That's coming up next. You're watching Bloomberg Surveillance.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Headed toward less than 2 hours ahead to that key PPI data, the beginning of an inflation data dump. We are seeing markets searching for direction. Very much front and focus has been the commodity sector, as Peter Scheer was mentioning over the past couple of months, under surveillance this morning. Very much whether we see inflation in commodities.
And I've got to admit, over the past couple of weeks, I'm increasingly looking at the commodity market and getting more and more nervous that inflation is actually going to creep up through the commodity market. And that was off my radar, I would say, 2-3 weeks ago. And as you look through the data, I don't want to say stagflation. I don't think that's a realistic situation, but I can't dismiss it as easily now as I could a month ago.
Here's the latest. Oil steadying, WTI hovering around $79 a barrel as traders await OPEC's next move and inflation data. Meanwhile, on the other side, copper touching its highest level since 2022, fueled by forecasts of a global supply deficit. Jeff Curry of Carlisle joining us now. And Jeff, that's where I want to start. Traditionally, people focused on oil prices. Right now, what we're seeing is oil steadying, but we're seeing the rest of the commodity complex surging ahead, up some 8.2% since the end of February. What makes for the divergence?
Copper is the new oil. We put out a piece back in 2021, making these bullish arguments. And by the way, they haven't worked out. But I talk to a lot of people who will say copper is their highest conviction trade. I wear my copper bracelet right here. It is the highest conviction trade I've ever seen. If you've got decarbonization, green CapEx demand, AI, data center demand, military demand. It takes 12, sometimes 26 years to bring on new supply. You can't come up with a better story. But the bottom line, we've been telling this story for 3 years, and maybe now it's beginning to work. I'm confident that this time it's liftoff, and I think we're going to see more momentum behind it because you have 3 sources of demand this time around, meaning green CapEx, AI, plus military. Back in 2021, all we had was the green CapEx demand, and now it's in full force. Supply's not there. Inventories are tight.
Prices have more than doubled going back to March of 2020, and I'm looking right now. How far more is there to rally at a time where you're still wearing your copper bracelet?
I think, our target was $15,000 a ton when it's trading, just a little bit above 10,000 as of this morning, which means, it's got a long ways to go. Where do we come up with that 15,000? It was the highest real price ever reached in 1968 during that housing boom. So we don't know where demand destruction occurs. All we do know is that bringing on new supply is very difficult. So we're going to learn where those price levels are, where you begin to kick out demand. But I go back to the 2000s, and as bullish on oil then as I am copper today. Oil ended up going up from 20 to 147 times. So, the upside on copper here, I think, is very significant.
We're seeing a lot of supply when it comes to countries outside of OPEC plus, Jeff. Do you think that potentially we're on a bearish trajectory when it comes to the oil market for this year and next?
Absolutely not. One of the big sources of oil supply over the last 18 months came from sanctioned countries. Venezuela, Iran, Russia. Yes, they've attacked these sanctions and clamped down, but they don't come into effect until after the election 180 days from now. So that's been one of the big drivers. And also in energy, don't forget the massive surge in coal production that occurred in China, Indonesia, and India over that same time period. So there's a lot of energy in the system that has backed up that needs to be eaten through. When we think about the underlying demand, it's not spectacular like it is in copper, but it's rock solid. It's well above long-term average growth rates. You're going into the gasoline driving season, jet fuel, and by the way, remember, global warming means your cooling season is going to create more demand in the past. We didn't build inventory, so that 3Q bull story is still very much intact, driven by fundamentals, even without any geopolitical risk priced in. Also on oil, I want to note that when we look at positioning, it's down to the 14th percentile. Now,